The way that I'm describing the evolution of the economy right now is an incremental slowdown. I don't see this as actual weakness.
It's not necessarily that the economy is at a different point, but I think the balance of investors' concerns have changed.
Yes, you're going to see some weakness, but you're also going to see some areas of strength.
The odds of a soft landing are much higher, and the risks have become a little bit more balanced.
When you look at the underlying fundamentals, yes, the economy's slowing, but in a good way.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
This is what a week in August feels like it should be, right? It kind of is range-bound. Good morning. Welcome back. This is Bloomberg Surveillance. Anne-Marie and Danny here with me today. John is still on his week-long Disney cruise. What a difference a week makes. Honestly, last week started with fireworks on Monday. This week, Danny, not so much. Yesterday, a pretty quiet day, which was very refreshing for a lot of people.
Yeah, is it return to normalcy or is it the eye of the storm? I think a lot of concern that people have is that markets are right back where they started this morning with the huge rally in the Nikkei. Japanese stocks are back to where they were before the sell-off. So maybe we're just the same setup we were last week.
It's set up going into a slew of economic data. We're starting with PPI today, coming up at 8:30 a.m. Eastern, just in about 2.5 hours time. Then later we get Home Depot at some point this morning. A whole sort of a number of indicators, Danny, that potentially could also really disrupt where we are.
Right, because kind of thinking about what demons have we exercised over the past week. The one that still lingers all of us is where we are in this economy. And it's just been tier 2 data that's been whipsawing this market. Today, we get real robust data followed by tomorrow's CPI and retail sales.
And we did just get Home Depot numbers. And you can check that out, Danny, for us, because it is a pretty big disappointment, akin to the disappointment that already was expected. But in the meantime, really the geopolitics front and center, Anne-Marie. And this, to me, very much is the center of the focus. Right now, Home Depot, we'll get to that in 1 second, seeing full year comp sales down 3 to 4% versus the expectation around 1%. Danny, why don't you take a look at what's going on with that? Right now, I do want to set you up, though, Anne-Marie, with a sense of the oil markets and how this is sort of playing out. Yesterday, with Brent seeing the biggest one-day pop, according to some metrics, going back to November.
A lot of geopolitical risk now coming back into the price. A lot of that had waned in the prior few weeks. I think yesterday what a lot of people are really looking at is what the White House said. John Kirby came out and said Israel believes it's, quote, increasingly likely that there'll be an attack by Iran and its proxies. And then he said, we share those concerns. And whether or not you're looking at words or the movements, what you see from the United States is they're sending more weapons into the Gulf. They are preparing, either whether you want to call it deterrence or defensive state, they are preparing for this potential retaliation by Iran.
Which is the reason why people are looking at this as potentially some sort of disruption. Danny, you've had a second to look at Home Depot. What do you see?
It is really weak. I'll just reiterate the headline that you read, that they see their full year comparable sales down 3 to 4%. They did see about 1%. This quarter was bad, too. 3.6% decline. The estimate was for 2.6%. I just want to read the quote from the CEO, Lisa, because I think this captures all of it. Ted Decker saying, higher interest rates and greater macro uncertainty pressured consumer demand more broadly, resulting in weaker spend across home improvement projects. So it's not even just the weaker consumer, which we knew about for a lot of these home-related goods. It is higher rates that's having an issue, putting pressure on this housing market, meaning turnover is slow, meaning people aren't shopping at Home Depot. And again, these other housing-related stocks because they don't need to. They don't have new homes.
Meanwhile, people are sort of parsing through this. Is weakness good or is it bad? Right now in markets, again, with a little bit of a lift to start the day, although, again, nothing that material. What we're seeing right now in the S&P 500 is just a mild gain, up about 0.3%, as we saw yesterday. That faded as the day went on. Euro actually dipping just a touch. Question of how much some of the rate cuts have been overpriced in the market. Euro 109.19 versus the dollar. 10-year yield. This is a place to watch. 392 actually dipping slightly yesterday after the New York Fed inflation expectations came out, with the 3-year metric coming in at the lowest going back since the series began in 2013, and crude just a touch softer after that huge rally that we saw yesterday. Coming up this hour, we've got Mark McCormick on TD on why the U.S. dollar looks cheap. Amrita Sen of Energy Aspects as crude rallies on Middle East tensions, and Kathy Bostjancic of Nationwide ahead of key U.S. economic data. Let us begin with the top story, counting down to U.S. PPI at 8:30 Eastern. The first in a string of key data points coming out this week. Mark McCormick of TD writing this: the U.S. dollar looks cheap to the global risk events piling up and the steep Fed cut pricing seems excessive and overdone. The FOMC is closer to rate cuts, but not as urgently close as markets are pricing it to be, and we are cautious of a correction. Mark joins us now. Mark, you are not in consensus, which is a good and beautiful thing. It's always great to hear a counter argument. Mark, you actually see dollar strength ahead. Why?
Well, I think you put together some of the pieces. One of it is the global economy is not really that strong. And we're talking about geopolitical tensions where you can see an escalation in oil prices. Like if we take ourselves back to 2022, why was the euro weaker? Why did Asian currencies weaken? Why did the yen weaken? It was in terms of trade shock. Currencies that import energy prices and commodity prices do not like the uncertainty around that. They don't like the potential for oil prices to move higher. And I think also what's very, 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 very important, and this is something we've been highlighting for months now, is the Goldilocks scenario that we've been in is been tipped over. And again, maybe it was U.S. employment report that broke, it was a straw that broke the camel's back. But if you look at like high frequency data in China, if you look at data surprises, data trends, consensus revisions, data and the growth story is weaker in China than the U.S. And then if you look at what's happening in Europe, it has peaked from a very low level coming to a modest level. And European data trends are also peaking. So there is no country here that can offset the slowdown in the U.S. And if U.S. data is slowing, this is where we move to the part of the world where the U.S. dollar rallies, the yen rallies, the Swiss franc rallies, largely, again, as a safe haven bid. So that's the thing that really worries me is everyone's looking at the U.S. in a vacuum. But what we should be doing is looking at the whole entire global picture, which is the world is actually moving into a slower place, which reinforces more volatility and also more safe haven demand.
We see that with respect to China's demand, for example, with oil, which we're going to get to in just a second. You write, though, and this I find interesting, and this is also counter consensus, that you think market risks are asymmetric right now, that the U.S. dollar should rally on good and bad surprises here, which is exactly the opposite of the bad sort of response to good news or bad news that people were seeing and saying yesterday and last week. How do you sort of rationalize this?
Well, I think it's this way. It's like what the consensus is, especially on the inflation number. That's kind of the key number we're thinking there's asymmetries around. There's 4 Fed cuts priced in this year, and there's more than that priced in next year. So the way we're looking at it is, number one, we don't expect 4 Fed cuts. We don't expect an emergency cut. We don't think the Fed needs to cut 50. You talked about the Atlanta nowcast, which is still running over 2%. For me, in terms of like tactically come into the data, if we get a strong number, in terms of inflation, 0.3% on core inflation, the dollar's going to rally because we're going to price out a Fed cut. We're going to price out the 50 for September. We're going to move back to something that's probably in line with our expectations, which is maybe get 3 cuts this year. If you get a bad number, very low inflation, kind of at the lower end of the range, I think the market gets spooked about the uncertainties of global growth, of U.S. growth. Are we heading into a recession? We titled our weekly narrative whiplash. Like essentially that's what we're going through here is the stories keep changing, the vibes keep changing. So essentially what I would think here is both of those extreme numbers are good for the dollar. One, because it prices out the Fed and the dollar gets a recovery based because U.S. 10-year will probably rise and U.S. yields start to rise a little bit. The other one is we move into the uncertainty around a global recession, the slowdown, and the narrative changes to that. So that's where I think the most boring outcome will be on consensus, and we probably won't get much of a reaction. But any of the extremes, I think, are both bullish for the dollar, at least in terms of the data this week.
Mark, that's not necessarily what we saw after the weak jobs report, though. And obviously, a lot of that people pointed to the idea of there's too much leverage in the system, too many carry trades built up. Does your view then assume that a lot of that is washed out?
I would say tactically. So you have to, I think we think about flows, especially from the Japanese perspective and the carry trade perspective is, coming along with the unemployment report, we got a surprise hike from the BOJ. It was not a surprise to us because we were calling for the BOJ hike. We've actually been suggesting this for months, that the BOJ is going to be much more aggressive because they have to be, and that Japan is as basically as a country, the government, the pension funds, and essentially the central bank all had to move in a direction that moved into a stronger again. And I think a lot of this had to do with, where we were in the prior election cycle when before everything changed. But I think, a big piece of what happened here is you have all of these things that we don't know what the trigger is, but the conditions were that Goldilocks was unsustainable. We needed more macro volatility, whether it was equity, fixed income, or currency. all that the employment report did is it worked with the surprise move by the BOJ that the market wasn't priced for. You got a very weak number that is actually quite distorted, and the market kind of implodes. And I think this is exactly the definition of a complex system that's trying to figure out what it needs. You don't know what exactly the combination of triggers will be, but we got those triggers in a smart period of time when people are away for summer. And again, I think a big piece of it is the tactical trading side is completely been washed out. Our models show that on positioning, the yen is quite long, it's quite over-owned, but I would say structurally, you have to think about the amount of money that Japanese pension funds and other institutions in Japan, the amount of money that they have leveraged to the rest of the world, particularly in U.S. technology stocks. That is something that's not going to get washed out over a quarter or a month. Like, these are positions that are set. They're set on an asset allocation mix. Those decisions are decided once a year. Those targets are met, and those are conditions that take a long time to trade. So I would say tactically, all the stuff that's been washed out, the carry trade is probably washed out from hedge funds or leverage money. But I think when we think about the capital flows, we haven't even started to see a reversal in some of the carry trades that have been on for years now.
Mark, I just wonder how that plays out, because presumably these are people who hold longer term contracts, so they probably won't even know the losses that they saw last week for some time. So what does that look like as those realizations pop up?
I think piece of it is people are going to sit around and think about the investment profile for the next year. Obviously, you won't get the asset allocation targets from a lot of these. Again, there's a lot of investors that aren't worried about a shoulder tap kind of on a monthly or weekly basis. So they will sit down, strategically think about how they view the world. What is the asset allocation mix? If you think about just JGBs from a Japanese perspective, pension fund allocation about 10 years ago was about 60% of their fixed income investment. Now it's down to about 20%. So a big piece of this is, like, say, the pension funds will sit around, they're going to make a decision and say, we need to have a higher allocation to JGBs. And the BOJs are going to say, we need to give the pension funds a reason to repatriate this money home. So we're going to continue to, again, do quantitative tightening. We're going to let the curve steepen, or we're going to raise interest rates. They're going to have a profile that allows that mix over time to make more sense for the pension funds. So it's not going to be ripping off of the Band-Aid. It's not going to be knee-jerk. So it's going to be much more strategically thought out. And the other big piece here is, even if you look at the balance of payments, there's probably at least $1.5 trillion outstanding in yen, just based on a 50% hedging target from some of the allocations you can see in the international investment position. You cannot capture any of that data. You don't know where it goes. A lot of it's residuals, but essentially much of it is unhedged. So unhedged repatriation of yen over thinking quarters of time will realize a much stronger yen if Japanese pension funds have a higher allocation to say, hey, we have a target. We're going to buy more domestically driven stocks, and we're going to buy more domestically driven JGBs. That will naturally lead to a stronger yen because of the lack of hedging that they've had. And we know that they are unhedged because it costs so much money over the last 4 to 5 years to hedge, given the shape of the yield curves.
Mark McCormick of TD, thank you so much for being with us. I just want to go back to Home Depot, which did come out with disappointing results. Looking at same-store sales in particular, those shares lower by almost 3%. They were expected to be negative, and yet this was worse than expected. Danny did a really good job looking at the commentary from the CEO during the quarter. High interest rates and greater macroeconomic uncertainty pressured consumer demand more broadly, resulting in weaker spend across home improvement projects. The CFO, in a separate interview, said this: pros tell us that for the first time, their customers aren't just deferring because of higher financing costs. They're deferring because of a sense of greater uncertainty in the economy. We will be talking about that coming up more throughout the morning ahead of a whole host of data, including retail sales, to get a sense of whether this is an idiosyncratic story about a company, about an industry, or something much more broad. Let's get to an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Investor confidence in Germany's economy slumped to the lowest since January, and expectations gauged by the ZEW Institute fell to 19.2 in August, far below the 34 expected in a Bloomberg survey. The recent figures have painted a gloomy picture for Europe's largest economy, with output unexpectedly shrinking in the second quarter and private sector activity providing little optimism. General Motors is struggling in China. Bloomberg reporting the U.S. automaker has been laying off staff there and will soon meet with local partner SAIC to plan a larger structural overhaul of its operations. This represents a major shift in strategy for GM, which earned billions of dollars in China as recently as 2018. But GM isn't alone. Many foreign brands are struggling to keep up with local competitors in the world's largest car market, which is now facing massive overcapacity. And the NFL is meeting with a handful of private equity groups this week. According to people familiar with the process, it's a step toward opening the league's ownership ranks to institutional money. The meetings are intended for the league to conduct more due diligence, but also to talk through potential policy preferences. The NFL is the only major U.S. league that doesn't allow institutional investors. It has spent more than a year observing results from other leagues and discussing what it might do differently. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Israel preparing for a response.
We share the same concerns and expectations that our Israeli counterparts have, but we have to be prepared for what could be a significant set of attacks. We have increased our force posture and capabilities in the region, even in just the last few days.
That's coming up next. This is Bloomberg. If you want to be confused, here you go. We just got Home Depot earnings, which disappointed. Some pretty dire commentary from leadership talking about consumers really withholding some of their funding simply because of geopolitical concerns and just macroeconomic concerns. And then U.S. small business optimism comes out, increasing to more than a 2-year high over in July. Put those things together. Welcome back in the markets to put it together. A mild lift to the S&P after the pullback of last week that was quickly reversed, up about 0.3%. And you could see yields just marginally higher after a dipping, but really somnolent in markets this morning. Not somnolent in oil, and that is where we want to focus. Under surveillance this morning, Israel preparing for a response.
We share the same concerns and expectations that our Israeli counterparts have with respect to potential timing here. Could be this week, but we have to be prepared for what could be a significant set of attacks, which is why, again, we have increased our force posture and capabilities in the region, even in just the last few days.
Here's the latest. The White House warning Iran may launch an attack against Israel as soon as this week, following days of threats. Crude markets a bit softer today after yesterday in Brent seeing the biggest one-day rally since November, driven in part by tension in the Middle East. It does seem to be percolating to the surface. Amrita, Sen of Energy Aspects, joining us now. Amrita, I want to start there. How significant could this be for the energy market?
I actually don't think the increase in Middle Eastern tensions, even if that were to transpire into attacks, will lead prices significantly higher. Even in the past, we've seen traders actually sell the news, and unless and until there's an outright supply outage, we aren't actually going to see prices move up materially. In the short term, of course, there's a risk premium that's kind of coming back into the price. It hasn't been in there for most of last week, I would say. So yes, you could get $1 or $2 here or there, but generally speaking, the view in the market, including ours, is that we do not actually expect outright supply losses from these escalating tensions.
This is fascinating and something that we have heard from other people. Amrita, do you think that yesterday's response in crude markets was tied to what we heard with the U.S. moving nuclear capabilities to the Mediterranean to back up Israel?
I think there is definitely a part of the price move that can be attributed to that because tensions are rising. And even recently, Israel has sent warning signs by attacking oil depots in Iran, saying, look, oil facilities are not off the target. Now, again, not the base case that they're going to actually attack oil facilities, but that can't be ruled out. I will say, however, is that the underlying impact or the underlying driver of oil prices has been this continued tightness in the Atlantic basin. U.S. production growth is slower. we actually are staring at very, very low, potentially record low utilization in U.S. stocks by the end of this month. That's why the note we put out yesterday, we called it stocked out. And I think that's the bit that's underlying the strength in the market. You've seen the WTI backwardation closing in on $2. And I think that's separate from the Middle Eastern tensions.
When you look at the IEA report today, Amrita, it says that global oil markets are going to go from deficit to surplus. So where does that leave the big producers? Do you think they're going to have to ratchet back some supply?
Yeah, and our balances have been showing that for some time now, that we have a huge draw in Q3, but flips to a very small kind of flat to build next quarter as OPEC gradually starts to unwind. But what I will say in terms of OPEC policy, they always have mentioned or maintained rather that all their policy is dependent on market conditions. Should inventories build too much, and we've seen a bit of a macro scare recently as well, then they will reconsider their decision. Of course, no decision has been taken yet. It's still a couple of weeks before they have to do so. But again, I think they will remain vigilant. As of now, our balances do show that they are bringing back barrels.
But what's the floor? We do see this risk premium coming back into the price because of what's going on geopolitically in the Middle East. But what's the floor when it comes to supply and demand? Does OPEC Plus, you get the sense, want to at least be able to hold $75 for Brent?
I think, again, OPEC Plus is not targeting a price here. They are looking at fundamentals. But where we see the floor for crude is around $80 for Brent because, yes, fundamentals in Q4 do not look bullish. But right here, right now, stocks are very low. So when you are building, but from record low stocks, you automatically provide yourself with a significant buffer, or rather, like you are able to build a lot more before the market becomes oversupplied. So I think it's a nuanced point, but I think it's an important point is where are we starting building from? Because that makes a big difference. And remember, we've also got outages in Libya. Sharara, we've seen kind of through our satellite imagery that, that's been offline as well. So again, those things, if that continues, it makes it easier for OPEC, for instance, to bring barrels back and still have $80 Brent as the floor.
You mentioned the macro scare, Amrita. How much does it change things if the macro scare goes from a scare into reality?
So one of the things I found fascinating with the macro scare, like last week, is the fact that oil has actually been sending these signals for a few months now, pretty much since May. Oil's been stuck in a range. We've been kind of seeing lackluster demand numbers, about 1 million barrels per day or slightly lower. And pretty much every signal from the oil market has been global growth is slowing. It's not doing great, and especially China. But suddenly now the equity markets have woken up to it. So it's just a delayed reaction. What I will say is by no means is anything suggesting that we are stepping into a deep recession. So I think the market's overshot. And I think this is exactly why oil managed to remain pretty unscathed and actually recover its losses because it had already been pricing in this slowdown in global growth. So I think it's just that the other asset classes have woken up to the reality.
Amrita, are we going to see a $100 barrel again?
Of course, at some point. I'm just not sure it's going to be this year or next year, barring an outright geopolitical event. And, that could be U.S. elections and impact on Iran and so on. But right now, given where demand is with the Chinese weakness that we are seeing, it's, again, still growing, 1 million barrels per day global demand growth. But you don't have China firing on all cylinders. And OPEC Plus managing this market, I think you will see stable prices, but more likely in the 80s than $100 oil.
Amrita Sen of Energy Aspects. Thank you so much. And we talk about China weakness. I wonder on a broader scale, whether we're also going to be worrying about U.S. weakness if Home Depot is less idiosyncratic, Danny, and more representative of what we're seeing more broadly.
Yeah, I guess in a roundabout way, though, you could say, well, maybe people are traveling less, they're in their cars more, so the oil usage kind of is up in the air, maybe in that regard. But it's true. Already we know China is weak. The oil market is reflecting that, to Amrita's point. What does it mean to reflect American weakness in the oil market, too?
And whether we've actually seen that, especially if you see crude production cut back.
Well, right now we're peak driving season in the United States, but the United States is making up for that Chinese weakness. So if the U.S. has a real growth scare, that's going to be very difficult for this oil market.
Which is the reason why a lot of people are currently out there on road trips, expending a lot of fossil fuels. Coming up, stocks edging higher ahead of key U.S. economic data. That conversation coming up next with Michael O'Rourke of JonesTrading. This is Bloomberg. difference a week makes. Last week, we were talking about turmoil and a vol shock. Today, we're talking about a quiet, typical August kind of week. Right now, what you're seeing in equity indexes pretty much across the board. Retracing some of the gains from earlier in the session, but still positive. 53.78 S&P futures up about 0.2%. NASDAQ up about 0.3%. But I want to sit on the Russell 2000, down about 0.3%, yet again underperforming. A reversal of the trade maybe that we saw building up. Danny, a real question about how much this is tied to true growth concerns starting to percolate into the picture.
And you get the feeling that maybe the money going into the Russell 2000 was with weaker hands, so you go away with weaker hands. A lot of the outflows came from the ETF. $2.6 billion was pulled from the ETF tracking the Russell 2000. So as soon as you get a whiff of those growth scares, what do we all do? It seems we run away from small caps and, at least over the past couple days, run to our safe and friendly big tech stocks.
You know, it's hard to really get a handle, though, Amrita, on what's actually going on and how much this is real and how much it isn't. Yesterday, how many guests came on the show and said basically this is a technical issue, not a fundamental one? And then we hear Home Depot come out, which we'll get to in just a second, talking about how the consumer truly is showing a weakening appetite to spend.
Which is also interesting because we got the New York Fed survey yesterday, and actually inflation expectations at the 1 year are lower. And then the Cleveland Fed came out with what executives are feeling. They're also feeling a bit more optimistic where inflation's going. So you would think that we would start to see more of a pickup when these earnings come out.
You feed that through the bond market, and what you can see is yields not really doing much, basically edging just a touch higher on the longer end and a touch lower on the front end, but basically flat, especially compared to what we saw last week. Key question will be, and this is what I actually am curious to ask throughout the morning, how poised is this market for either a sell-off or a rally if we get a CPI print that shows disinflation? That, to me, Anne-Marie, is going to be one of the key questions at a time where we're looking at a 2-year yield around 4% and a 10-year yield much lower than the 4.5% people were talking about earlier.
Well, Michael O'Rourke, who we're about to speak to, calls this a double-edged sword that the Fed will be dealing with today. We've been in this bad news is bad news market consensus right now. What if there is a deceleration or if inflation accelerates so much that the FOMC aggressive easing as the labor market slows? This is what he's talking about. He said on that side of the other side of the sword, the Fed's greater fear that the risk that inflation decelerates too quickly that it turns into a contraction.
Well, it's definitely a different setup because basically for the entirety of this year, it's been an asymmetric skew to CPI beating to the upside. That we continue to price in more Fed cuts and then CPI surprises to the upside. And basically that undoes a lot of what this bond market has done. You kind of get the feeling that maybe it's that setup again. If we've priced 200 basis points worth of cuts through the next year, that maybe we aren't ready for a CPI pickup and a market is more braced for downside.
Which is really what we were hearing from Mark McCormick on some levels. And if you push that through the currency markets, a real kind of existential angst. Has this sort of dollar weakness trade gone too far that has really been hinged and following on the rate cut story? This morning, you're seeing a bit of an increase in the dollar, 109.24 euro lower versus the dollar, albeit pretty quiet this morning. Under surveillance, Donald Trump and Elon Musk holding a friendly but glitch-delayed interview on X, Musk blaming a 40-minute delay on cyber attacks, saying there's a lot of opposition to hearing from Trump. The Tesla CEO also calling for a government commission to ensure taxpayer money is spent effectively and pitching himself, Emery, for the role.
Yeah, I'd be happy to help out if such a commission were to be formed. This is what Elon Musk said. I struggled listening to this entire thing once I was able to get on. If this was really about Trump pitching, viewers and listeners to vote for him, or Musk pitching Trump, not just about joining this commission, but also stop demonizing EVs, the electric vehicle space.
Well, this is actually, to me, one of the takeaways. And Danny, I'd love your thoughts on this from this interview. On what level will his friendship with Donald Trump potentially, should Donald Trump get elected, actually make it better for other auto manufacturers that are trying to sell electric vehicles?
Right, especially if you have a more conservative audience listening, not even just the policy, but a more conservative audience listening who's maybe more skeptical of EVs and Musk just wholesale pitching it, wholesale talking about climate change is an issue, despite Donald Trump coming back and say all it will do is allow for more oceanfront property. So you have this weird dynamic where they were talking about the same issues, but kind of talking past each other. So again, I wonder how much was a pitch to Trump and how much was a pitch to Trump voters?
And that's the reason why people were trying to listen in. A question about some of the technologies, too, with the greatest cutter and what that potentially could mean. Meanwhile, Home Depot, and this actually is important to sort of question whether this is idiosyncratic or whether this is indicative of what we're going to see from others as well. Cutting its full-year sales outlook, the company expecting consumer spending to remain soft in the coming months as interest rates and uncertainty weigh on shoppers. Comparable sales falling for the 7th straight quarter. Idiosyncratic, Danny, or something that's deeper?
Unfortunately, it is so hard to tell. And Morgan Stanley, I just want to say, has done a really fantastic job of tracking all these consumer companies. So Home Depot is going to be the latest one in the negative category. They say that a near record amount of companies are talking about the consumer on their earnings call. But this is the unfortunate thing, is that they are completely split down the middle on those saying that the consumer is healthy and those that are saying it's unhealthy. Obviously, the unhealthy ones are people like Home Depot, the ones tied to the housing market. Luxury companies a little bit more healthy. But even within some of those dichotomies, it's not so straightforward. So you come out with just a very confused picture of a consumer.
Well, Home Depot is talking about these higher interest rates, which feels like it's more of an issue for Home Depot's, Lowe's, potentially on the upper end if you want to have these bigger, more reinstallments of your homes, things like that. Mohammed Alarian says this is underlying an issue for the housing market, where affordability is also being undermined by still sluggish supply, highlights yet again critical importance of labor income for continued U.S. economic growth. So Home Depot feels like it's actually highlighting what's going on underneath the surface. But I still want to see what Walmart says at the end of the week.
And this was sort of the first salvo in a week of really key data points, including PPI data, which comes out at 8:30 Eastern, followed by the CPI report tomorrow. Michael O'Rourke of JonesTrading writing this. There's a number of key economic releases this week, and the market is likely to be highly sensitive to the major ones due to the bad is bad market consensus. The CPI report has the potential to be a double-edged sword. Michael, we were talking with Mark McCormick about how things were set up sort of to the negative in terms of how many Fed rate cuts were being priced in and some of the growth concerns that have dominated and fueled potentially some of the turmoil from last week. Do you disagree with that? Do you think that actually people are not pricing in what it could mean if one of these indicators surprises significantly to the upside or downside?
Yeah, I think, it's funny what you're talking about, the conference calls and whether the consumer's slowing and that mixed message out there. I think that's exactly what's going on in the market right now, where you're seeing a situation where if this was a month ago, you have those Home Depot numbers, and you look through them and say, well, it's the high interest rate environment, but we're going to get rate cuts before the end of the year, and that's going to improve. But now that you're seeing some weakness out there, and it's not small patches of weakness, that you're seeing some investors getting concerned. And I think people aren't fully positioned for this. And that's why you're seeing multiple contraction and obviously the correction we saw last week.
Michael, you called the trading pattern of last week, the market is reacting to noise. If last week was noise, surely this week is something more concrete with the data. Just given how it behaved last week, what does that mean for what we should brace for as PPI, CPI, and retail sales all hit the tape?
So, and that's the problem, right? The market's going to react to every one of those numbers. I would sit there and say the most important numbers are going to be the jobs report, initial jobless claims, and the CPI report. But because we're reacting to everything, it just shows the lack of confidence investors have out there. And it just shows a little bit more of a heightened risk to the environment.
Does that mean if I want to sort of divine a direction of these markets, that I can't do it, that I need to be really tactical short term and basically just watch it bounce up and down?
Well, what you need to do is you need to figure out what positions you want and where you want to be. And that's how you need to position yourself. You actually need to take this noise and use it as an opportunity to reposition. What I'd say the biggest shift in the past month has been is we've been in this environment where everyone's looking at this Goldilocks type economy that's about to see, Fed rate cuts. And I think that's why multiples are so high. I think that's why everyone was so optimistic, coming into July. And now we're seeing it's not quite Goldilocks. And there's a little bit of a risk out there of a hard landing. So now what you have to do is reposition yourself that there should be more risk in the back half of the year. And then when you get earnings reports like Home Depot here, that just reinforces the need to reposition yourself. So I think that's what we're going to see going on here is investors, when you have a downdraft like we had the last week, it's really hard to sell individual stocks, individual positions. What a lot of guys will do is sell futures to hedge their hedge their portfolios. And then when you get bounces like we've seen, they'll start selling stocks into it and cover the futures hedges. And I think that's what we're looking at in this environment right now.
Michael, what do you look at when you get a Home Depot and you see the concerns about the overall economy weighing on consumers, but then you get the New York Fed survey, the Cleveland Fed survey, when it looks like consumers and CEOs are actually more optimistic about inflation expectations?
Yeah, well, but that's very consistent in the sense that inflation expectations are slowing down with the economy. Right. So if the economy slows, inflation expectations, come down. And again, that comes back to the risk we have with a double-edged sword with the CPI report tomorrow. Whereas we've spent the past several years just hoping for cooler than expected inflation. But prior to the pandemic, for 2 decades, the Fed's fear has been disinflation. So again, if you get a number that contracts too quickly, all of a sudden fears come out that the CPI report is showing us that the economy is slowing down too much. And then, the Fed really gets worried about a situation like that, because again, that's where you have to be really aggressive with easing if that were to pick up momentum.
So CPI is supposed to come in 0.2% month over month. If we get anything besides that number, what are you expecting in the market, actual markets reacting? How big does the either upside or downside surprise need to be?
If we get a just standard month over month, if we get 1/10 to 2/10, we're right in target with the Fed. So those are great numbers if we can get them. I think if we get 1/10, that's fine. If we get 3/10, that's probably fine as well. I think anything beyond those numbers, I think you should see a reaction. I mean, where we've had a 3-month CPI is running at an annualized rate of just above, right below 2%. And although the 6-month rate is annualized rate's higher, January was a 0.5 reading. So when the 5-month rate is right in the Fed's wheelhouse too. So we just need to see this trend that we've been on continue. But again, you're really trying to hit the middle instead of do better or worse than, which becomes a little more challenging.
Michael, I have to say, since 6 o'clock when Home Depot earnings have come out, S&P 500 futures have almost entirely reversed the gains from earlier this morning. You've seen the Russell 2000 fall further negative, down now about 0.4%. How skittish is this market that any one economic data point or even earnings report, no matter how big or small, can spook everyone?
I think it's very skittish. We're coming from extremely high valuations historically. Those magnificent 7 members were trading 45 times earnings. Now they're down to 40 times earnings, 35 times forward, now at 30 times forward. And they're the biggest stocks in the country, in the world. Stocks that large don't grow that quickly, except for NVIDIA this year. So again, there was a lot of optimism priced into this tape, and I think there's actually a number of attractive stocks out there. If you go into small caps, if you go into this, the S&P 600 or the S&P 400 mid caps, there are attractive names. There are attractive groups out there, but everyone's so weighted to the mega caps, and obviously that drives up the multiple for the S&P 500. And again, the environment is not this Goldilocks outlook where we're going to have rate cuts. It's definitely more in doubt, and you have to price in more risk right now.
Michael O'Rourke of JonesTrading, thank you so much for being with us. And we do see a bit of a reversal from the earlier rally as people take a look, frankly, at Home Depot. I can't think of anything else, Danny.
Yeah, they look at Home Depot, and Michael O'Rourke put it great that every time you get a Home Depot, you just got to reposition. It's a market still bracing for Goldilocks. Bank of America's latest fund manager survey, I think, underlined that perfectly. 76% of respondents still think there'll be a soft landing. And even after the chaos of last week, the most crowded trade, still big cap tech.
I thought that was fascinating. I'm glad you brought that up. Right now, let's get you an update on stories elsewhere this morning. Here is Yahaira Hackes.
Hi, Lisa. The Wall Street Journal is reporting that China's Huawei Technologies is close to introducing a new AI chip. The chip would allow China to overcome U.S. sanctions and challenge NVIDIA in the Chinese market. Citing sources, the report said Chinese internet companies and telecommunications operators have already been testing Huawei's latest processor, and the company told potential clients the new chip is comparable to NVIDIA's H100, which was introduced last year and isn't directly available in China. A Bloomberg analysis of government data showing U.S. retailers, including Walmart and Target, are selling generic versions of the cold medicine Mucinex that contain a cancer-causing chemical, benzene. The chemical is unlisted and found inside a cheaper version of an inactive ingredient in the store brand option. U.S. regulators have ordered the ingredient phased out, but the deadline has been pushed to 2026 after industry complaints. Staying on healthcare, Johnson & Johnson has cleared a key hurdle for advancing a $6.5 billion plan to resolve thousands of lawsuits by people who say its baby powder gave them cancer. According to people familiar, more than 75% of the group signed off on J&J's proposal through secret balloting. The settlement offer includes claims that the talc-based version of its powder caused ovarian and other gynecological cancers. Under J&J's current offer, it would make payments for current and future claims over a 25-year period. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, fighting for a soft landing.
To look at the economy in totality, yes, you're going to see some weakness, but you're also going to see some areas of strength. What we're seeing is a market of investors and speculators that are overreacting to economic weakness and ignoring economic strength in the Main Street economy.
That's coming up next. The muddled picture that really has not left with many with a clear sense of what's ahead. This is Bloomberg. Coming into a much different week than last week. This one is quiet. We're seeing the S&P basically almost flat after a disappointing earnings report seemed to temper some of the earlier optimism across the board, a sleepiness that we saw a similar kind of action on yesterday. Under surveillance this morning, fighting for a soft landing.
To look at the economy in totality, yes, you're going to see some weakness, but you're also going to see some areas of strength. What we're seeing is a market of investors and speculators that are overreacting to economic weakness and ignoring economic strength in the Main Street economy. This data week is so incredibly important because not only will you see financial market indicators, you're going to get a sense of how Main Street is doing next to all of these price data that the market is following so closely.
Here's the latest U.S. PPI data due at 8:30 Eastern, the first in a series of key data points this week, which may shed more light on a muddied picture. Meanwhile, we did get Home Depot earnings coming out, which also shed some light. And if that is Main Street, it is looking a little less rosy. Kathy Bostjancic of Nationwide Mutual writing this: with economic growth slowing, the labor market cooling, and monetary policy still restrictive, we should see inflation trends moderate through the second half of this year. Kathy joins us now. Yes, inflation is going to be important. We get PPI in less than 2 hours. We get CPI tomorrow. But how much is the focus still so squarely on growth concerns?
Oh, good morning, Lisa. Happy to be with you. Well, I think the concerns are pretty high, and I think they should be. Our base case is that we have a soft landing than we thought before. But I think, recession odds are high. And a big part of the reason is because the Fed has been holding monetary policy restrictive. If you look at their own Fed Taylor rules, they're, even as of February, about 100 basis points tight. Now, that made sense when you were worried about inflation running high. And I understand, we had that inflation scare in Q1. But now when you have concerns about the labor market and that could have a follow-on impact on the consumer, that really cries for the Fed to get going and cutting rates. So they may be too slow, and that's just something that we have to watch.
Kathy, how do you understand all the muddied indicators? We were talking about Home Depot coming out. And a real question here, is it idiosyncratic when it cuts its forecast and talks about how consumers are increasingly deferring their purchases? Is this a housing-specific issue? Is this a Home Depot-specific issue? Or is this something broader that you're seeing in other metrics as well?
Yeah, it's really broader. When you look at the earnings announcements and the guidance that comes with it, the companies that, by and large, that are sensitive to the consumer or consumer related, they've really painted a picture of that the households are becoming more frugal and cautious with their spending. And that just, again, ties in with what we're seeing in the real economic data, that employment growth is moderating, wage growth is moderating, and the consumer is still facing, even though inflation's moderating, that's a growth rate. When you look at price levels, especially in the service side, they're not going down. So, and as you know, the many consumers are tapped out on credit, especially lower income households. So this is a consumer that's hitting constraints, and the tailwinds behind them are just not there.
Kathy, how should we think about the difference between a picky consumer that is stretched versus a consumer that's deteriorating rapidly, something that would eventually lead to a recession?
Yeah, what we'll be watching closely is the labor market, because I think now you have consumer spending, it's going to be in sync with incoming income. Before, consumers could tap into the pandemic-related savings. In fact, we saw that, and they could rely on credit cards. Those tailwinds have diminished. So now you're in sync with income. So that really points to labor market. And as long as we're getting job growth around 100,000, I'm not, going to be calling recession, around the corner. But if we start to get, lower than that, closer to zero, when it turns negative, then, the game is over, and it, we're very much likely, heading into recession.
Well, Fed officials, Mickey Bowman being one of them over the weekend, giving herself comfort on the labor market, saying that, sure, hiring has slowed down or even stopped, but layoffs haven't started. Kathy, should the Fed be taking comfort in that? Or is the very fact that hiring has stopped enough to damage this labor market?
Yeah, I think they have to be careful about looking at lagging indicators like layoffs and the unemployment rate. And also remember that they've got policy restrictive. If they said the risk around inflation and employment are getting more in line or more balanced, they've got policy rate that's probably 100, 125 basis points at least too tight, like not even at neutral right now. So I think they do have to be careful. Yes, things are still strong now, and I don't want to, I think what happened last week was an overreaction. But that said, it should be, motivator for the Fed to take a look and start to be, more open to larger rate cuts.
Kathy, as we've been talking about, we're looking at the consumer. They are still spending, just not as much. You talked about the fact that some of those pandemic funds have dried up. How will we know that consumers are seriously concerned about a deterioration in the labor market?
Yeah, there are measures in some of the conference reports, like the conference board has measures, jobs hard to get, jobs plentiful. Those are good measures to watch. They line up pretty well with some of the employment data. And I think also initial jobless claims just takes on increased importance here, and continuing claims. It's not just the initial, but continuing claims. And what we have seen is, this steady erosion. So far, it looks like to be in line with the soft landing. And indeed, that's our own forecast. But I will feel a lot more comfortable, again, if the Fed starts to lower rates. And they have a lot of room to do that. I mean, that's the good news with rates over 5%. But these high frequency labor market indicators like jobless claims, they just take on increased importance right now.
Kathy, just 30 seconds. I heard you say that perhaps a bigger rate cut is warranted. Are you calling for 50 basis points of a rate cut?
We're not, because I think the Fed is going to be cautious, at least start cautious. But I would feel better about the soft landing if they actually entertained or actually went 50 basis points and maybe follow up with another 50 basis points. We look for 75 basis points by the end of the year. But again, I think they have room to cut rates over 100 basis points by year end.
Kathy Bostjancic of Nationwide, thank you so much for being with us. Danny, 100 basis points of rate cuts or more than that. That's actually what's being priced into the market right now.
Correct. 100 basis points for the year, 200 for the next year. And it's just such a divide between what Fed officials and market participants think. Because Fed officials say that they do have luxury, they do have time, whereas Kathy's saying the opposite. They have room to cut. In the Fed's view, they don't yet have that room, and they need to wait for inflation to come down.
But if the Fed were to go 50 in September, would that be a tactical admission, basically, that they got it wrong and they were too slow? So now they're doubling down on how much they're going to go.
Well, this is the reason why actually inflation data is going to matter more this week than it has in many other weeks. It will show whether the inflation really still has to be the preeminent concern, akin to growth worries, which really have taken center stage. Coming up next, Troy Gayeski of FS Investments, Henrietta Treyz of Veda Partners, Alejandro Reynal of Four Seasons, and Matt Brill of Invesco. Have you seen that Four Seasons baby? Have you seen it? Talking about
it's everywhere.
Yeah, well, maybe that's a good thing for them. Anyway, this is Bloomberg Surveillance.
The way that I'm describing the evolution of the economy right now is an incremental slowdown. I don't see this as actual weakness.
It's not necessarily that the economy is at a different point, but I think the balance of investors' concerns have changed.
Yes, you're going to see some weakness, but you're also going to see some areas of strength.
The odds of a soft landing are much higher, and the risks have become a little bit more balanced.
When you look at the underlying fundamentals, yes, the economy's slowing, but in a good way.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance as we see increasing clouds over the consumer. Alongside Emery Hordern, together with Danny Berger, I am Lisa Abramowitz. John is out cruising for the remainder of this week. Right now, very much looking at consumer concerns that are pulling back some of the earlier gains in the session. Danny, Home Depot kind of driving the charge in fueling those concerns.
And Home Depot, the CEO in the commentary, very clear that it is a two-pronged issue they are facing. One, it is higher rates that's keeping this housing market frozen. But the change, Lisa, and you pointed to this, that it's now a consumer under pressure, that it's not just about higher rates, but it is a pullback in their spending too.
The key question, Anne-Marie, being, is this a Home Depot problem or is this a broader problem? And the answer is about as clear as everything else is right now.
I love on Home Depot, though, the CFO coming out and saying it's deferral. So basically, they're not spending right now, but we do expect consumers to come back. And Danny brought up the Bank of America fund survey, shaken, not stirred. They're talking about the fact that core investor optimism, shaken, not stirred, 76% still expect a soft landing. So maybe people are deferring for the next few months, and then we can maybe see a pickup.
From a market perspective, the key is the balance of risks. And this is a reason why people are watching PPI today in about 90 minutes time, and then CPI tomorrow so closely, because they're looking at this and saying, is inflation coming down enough to be written off as a main concern by the Federal Reserve? Right now, markets are saying yes, almost as a given, and that the Fed will have room to cut by 100 basis points later this year.
I actually wonder if it would make things worse if the Fed does something like a 50 basis point cut in September, because it's acknowledging that there is such a big risk. If they flip from saying, we're waiting for inflation to come down, to saying, you know what, we're going to do a jumbo 50 basis point cut, some market participants might have this idea. What does the Fed know that we don't? That they feel this need not to do an intermeeting emergency cut, but something that looks like an emergency cut of 50 basis points in a meeting.
Well, I think that's a great point, something people have pointed to as to why they won't do it, because they haven't signaled. And if they haven't signaled, they might surprise markets. That said, there's really a lack of clarity in terms of what the economy really is doing in terms of how much it's slowing down. You look on one hand, small business confidence coming in at the highest level in more than 2 years. And then on the flip side, and Amrita, I thought this was fascinating with the oil discussion. We're talking about geopolitical risks. We're talking about how that could lead to a potential oil surge. And what we're hearing instead is it's reflecting weakness, which is actually capping how much oil prices can rally.
Yeah, weakness in China, which really it's the fact that the U.S. is using more fossil fuels, is the fact of the matter is pretty much making up for some of that slowing demand we are seeing out of China, which has been a big concern for the oil market. But Amrita said, talking about what you're seeing in the price right now, this is just geopolitical risk. The supply in the market is not being touched, which is why she thinks basically maybe 80 is the floor.
Which is the reason why people aren't necessarily using this as much as a signal about geopolitical risk. It may be a little bit more of a muddied signal even when it comes to growth. Coming up this hour, we've got Troy Gayeski of FS Investments, as well as key inflation data. Henrietta Treyz of Veda Partners following a conversation between Donald Trump and Elon Musk on X, and Matt Brill of Invesco on why he still expects a soft landing in markets. It is quiet, although we we've retraced some of the gains that we had seen earlier in the S&P. Futures basically flat, and we're taking a look at yields also pretty much flat. So across the board, pretty quiet. We begin with our top story. Stocks looking for direction as traders await PPI out at 8:30 Eastern. CPI and retail sales data still to come this week. Troy Gayeski of FS Investments writing this. Significant weakness in the lower end consumer started to show up last quarter. Have we stepped down from excess consumption driven by excess savings to a new normal where consumption is completely dependent on the labor market? Or is there something more sinister going on? Troy joins us now. Troy, I will ask you your own question. What's the answer?
Yeah, we think it's a logical, rational slowdown from a period of time where the consumer just consumed like crazy, right? And when you step back, remember you had all the excess savings built up during the pandemic. We had a white hot labor market, not red hot, but white hot. And so what you've seen is a continued cooling of that to somewhere between, let's call it warm and closer to hot, which is where the labor market is today. That note in particular was referring to the earnings, and you were talking about Home Depot before. We think in this earnings season, there were two real questions. Like one, would mega cap tech continue to spend on AI aggressively and allow their margins to compress? So far, that seems to be the answer. And two, were there any signals in earnings that were incredibly disastrous like we had in 07, early 08, that signal the consumer was going from a period of strength to a period of acute weakness very, very rapidly? And we just don't see that in the data. We see slower growth, which is a necessity to cool inflation, and it'll allow the Fed to cut very marginally by the end of the year.
So what does this mean in terms of strategy? Because right now, it's unclear to me what the market's actually positioned for. Isn't that kind of describing the muddle that the market is kind of parsing out right now, this idea that we're not falling into recession by any means, but that we are seeing a slowdown that's going to be bumpy?
Yeah, I think it depends on the asset class. So if you think of strategies like private equity or private credit, what we've been fearful of is a hard landing at some point. We always thought those odds were low. But now they appear to be even lower now that a lot of recession indicators have gone from red light to something more normal. Because anytime you're in equity, whether it's public equity or private equity, you really fear that recession because it's much harder to grow EBITDA and earnings in a contraction than in a 1% to 2% real economic expansion. And then in terms of private credit, when you think about this, we've been able to earn excess income for quite some time. And obviously, we didn't want to give some of that income back through a recession-driven default hangover. So at this point, we're happy to concede a little bit of income from the front end coming down in order to keep those recession odds incredibly low, which we think they still are.
Troy, what indicators are you looking at that have gone from red to normal? Because most of the folks you've been speaking to are saying, quite frankly, exactly the opposite.
Yeah, so I think when you look at bank lending, for instance, right, this is one of the last indicators to flash red light, right? We had the inverted yield curve. We had money supply contracting. We technically had a recession, as you know, in 2022. But because the consumer was so strong, the consumption powered us through, no problem. So bank lending started to contract and then stagnate for several quarters coming out of the failures. And now you've started to see lending pick back up, albeit with tighter underwriting standards. And then you think of the yield curve was what we consider massively inverted, twos, tens by over 100 basis points plus. And that started to normalize to some extent. And then importantly, again, when you just get back to GDP contributors, there's an incredible amount of spends that are already built into the future through business fixed investment, not only mega cap tech, but also on the energy side. And then furthermore, government spending, for the most part, federal and state and local, with obviously the exception of California, which is still a wild card, continues to spend at a very healthy rate. And we know that's criticized by some, but growth is growth and jobs are jobs. And as long as labor market continues to create 100, 150,000 jobs, we should be able to avoid a recession. So some of the darker indicators are now, let's call it yellow to even flashing green, as we're expecting the Fed to cut later on this year.
What does that mean for your market call then, Troy? Because this is a bond market that is pricing in a level of cuts that looks something like a recession. So what is it? Is it short bonds, load up on risk then?
Yeah, well, let's not get carried away with loading up on risk. I mean, we're Northwest Quadrant, the efficient frontier people. So we like lower risk with, high single digit to low teens returns. We're never trying to, hit home runs or grand slams. But if you think of fixed income, look, our biggest criticism of bond permables has been this expectation that the Fed would gradually take the front end to 3%. And in that environment, the 10-year yield would continue to drop. And that would mean not only will we have the longest inverted yield curve really in a non-recessionary environment, but we'd continue to have a yield curve inverted as the Fed continued to cut. So when you think of fixed income, yes, the risk-adjusted returns are much better today than they were at the end of 21, when fixed income was the definition of return-free risk. However, it's really hard to argue you have material upside in the back end of the curve right now, but the front end should drop slowly over the next several years. Now, if you think of different strategies and alternatives, it's a great time to be a private lender if you have dry powder to lend into liquidity vacuum, partially driven by that pullback in the banking system, partially driven by just a massive growth in nominal GDP and the fact that there's a big shortfall in actual lending versus lending capacity. And then if you think of private equity, you really want to be in strategies where you don't need financial engineering, you don't need balance sheet leverage to generate returns. And that always brings us back to the middle market, where it's about organic growth as opposed to financial engineering and multiple expansion.
Troy, you say at the end of the day, the only thing that matters is mega cap tech stocks. So can these companies continue to maintain or even grow their margins?
Yeah, so I think that, again, was one of the key answers to this earnings season. The question, we had a 2 or 3 quarter period where despite massive growth in business fixed investment, AI spends, there was enough ancillary or core business growth, I should say, to drive margin expansion. What we see in this earnings season is that's over. And across the board in mega cap tech, the decision's been made to spend for growth. We'd rather overspend and not miss the boat than underspend and get left behind. So we have seen some degree of margin compression. Now, it's not a zero-sum game, but to some extent, when you think about what it means for semiconductor stocks or NVIDIA or others, it means those spends are going to be more persistent, and mega cap tech is going to look past margin compression to continue to spend aggressively. And the mystery, of course, which we certainly don't have an answer for yet, is what is going to be that key growth driver where there's a return on invested capital. But for the time being, markets are giving those companies a pass, just given their tremendous free cash flow growth.
Well, that key driver is going to be AI, is it not? Are you seeing anywhere in the space that you like what they're doing in terms of all of this massive spend on artificial intelligence?
Oh, well, again, the expectation is the key driver will. The key word is will, right? But you've yet to see in companies like Meta or Google or others a clear return on invested capital. You're starting to see growth. You're starting to see growth driven by that. But it's not like you've had this revolutionary moment quite yet. The expectation is that will come, and that would arguably be the biggest risk. If we get out 2-3 quarters and there still isn't an attractive return on invested capital, then that margin compression will probably be viewed much more dimly. And you got to take perspective evaluations here too, right? The Magnificent Seven minus Tesla plus Eli Lilly have only gone from 36 times forward earnings to 34. So yes, we've had a mini correction, but we certainly haven't had something that looks like 22 or what we used to consider a more pronounced correction in the 10 to 15% range for the broader market.
I love the substitutions, how people are trying to basically to redefine what Magnificent Seven means to them. Troy Gayeski of FS Investments, thank you so much, and have a wonderful rest of your summer. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. U.S. officials believe an Iranian attack against Israel has grown even more likely and may come as soon as this week. Allied leaders are seeking to head off all-out war, and the Pentagon deployed more forces to the region. Briefing reporters Monday, White House spokesman John Kirby said the U.S. and its allies have to be prepared for what could be a significant set of attacks. Some are surprised it has yet to happen, given Iran has threatened for days to retaliate after the assassination of a Hamas leader in Tehran. Israel has neither acknowledged nor denied responsibility for the killing. According to a global survey by Bank of America, the volatility in global financial markets hasn't derailed investor optimism around tech giants or expectations of a soft landing. The poll was conducted during the height of last week's turmoil and showed a defensive rotation into bonds and cash and out of equities. Meanwhile, long bets on the Magnificent Seven remain the most crowded trade, albeit less so after the sell-off. And Home Depot lowered its full-year sales outlook, signaling that it expects consumer spending to remain soft in the coming months. The company sees comparable sales falling 3 to 4% for the year versus the previous expectation for a 1% decline. The disappointing results come as consumers have held off buying homes or pursuing big renovations amid high interest rates and economic uncertainty. Comparable sales also came in worse than expected, falling for the 7th straight quarter. Shares are falling down 2% in the pre-market. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Pairing some of those losses, though, from earlier, down almost 5% at one point, as people really look through what the tea leaves actually are and how idiosyncratic and long-term this actually could be. Up next, trying to stop the Harris surge.
If we have her as a president, if we have a Democrat at this moment as the president, I don't think our country can survive.
I think really it's essential that you win for the good of the country.
That's coming up next. This is Bloomberg. Taking a look at a market that's seeking direction right now as we take a look at a host of economic data points, including earnings. Home Depot coming out weaker than expected. We get PPI in about an hour and 15 minutes, and then CPI tomorrow, with Walmart capping it all off with retail sales on Thursday. Under surveillance this morning, trying to counter the Harris surge.
She is far worse, they say, than Bernie Sanders. If we have her as a president, if we have a Democrat at this moment as the president, I don't think our country can survive.
It's essential that you win for the good of the country.
Here's the latest. Donald Trump taking aim at Vice President Kamala Harris in a wide-ranging conversation on X with Elon Musk. The conversation coming after Musk endorsed Trump last month, with Trump's campaign looking to curb a wave of momentum for Harris. Henrietta Treyz of Veda Partners joins us now. Henrietta, a lot to talk through about this particular discussion. I just want to start with, what was your main takeaway?
The main takeaway was that this was a great opportunity for X to promote spaces. I mean, over 1 million listeners at some point, but it was sort of 2.5 hours of two guys in a room agreeing with one another. I wouldn't call it an interview, but more of a conversation that touched on all the hits that you hear from a Trump rally or other press briefings that the former president puts on. There wasn't a whole lot of new information there. The main takeaway for me was that Elon Musk is interested in getting further involved in the federal government, being part of a federal sort of task force to take on government spending and efficiency, as he calls it. But that was really the newsiest part of the interview to me.
Henrietta, what I took away is that Musk was advocating for two key things. One, to stop this demonization, which I think some would view as coming from the far right when it comes to sustainability and EVs, but also deregulation. He brought it up a number of times. Do you think he was successful, Musk, in convincing Trump and potentially some Trump acolytes on that call?
I think that there has been a history of Musk being able to move former President Trump, specifically electric vehicles, government subsidies of that industry in particular. When it comes to deregulation, I think that's already a big part of the platform. When I speak with Republican staff, that's always a refrain. So I think there's a primed audience for that conversation. They could certainly be receptive to that. What's obviously interesting about that is that you simultaneously don't have the votes to repeal the federal subsidies for all of those industries in the clean energy tech space, the manufacturing tax credits. 18 House Republicans just sent a letter to Speaker Johnson saying, hey, we need those subsidies to continue going. They promote job growth in our districts. They're promoting, research and development. They're countering China. So I think they're going to have a lot of trouble actually governing on that agenda next year if former President Trump is reelected.
So last night was pretty light on substance, but potentially from the Harris camp, we'll actually get some policies on Thursday. We have not seen a policy proposal yet from the Harris-Walz campaign, and they're going to be coming out with this economic plan. What are you expecting?
Yeah, we're expecting the plan to be rolled out around Thursday. Obviously, there are not a lot of heavy hitting interviews happening right now, last night being an example. So I don't know that the Harris-Walz team needs to get too in the weeds. My advice to clients is to focus on the bill that the House Ways and Means Committee put out in 2021, which received, widespread support from the Democratic conference. It includes a top corporate tax rate of 26.5%. It's graduated in. And I think overarchingly, whatever Harris does put out on Thursday, take that as the high watermark. When you go into Congress next year, in the off chance it's not a Republican-controlled Senate, you're going to have to thread the needle very, very closely to get 218 votes on anything in the House and 51 or 60 in the Senate. It's going to be much more lenient than whatever a Democratic proposal comes out looking like on Thursday.
In the meantime, Henrietta, we're about a month away from early voting starting, and by all accounts, this is going to be a lot of early voting compared with historical references. Is Donald Trump more or less out of time in trying to define Kamala Harris?
I have two things to say on that. Number one, the most important thing that happened last night is that Arizona put the abortion issue on the ballot. That is something that got double the number of signatures that they need. They didn't bring abortion up once. That's the whole state of Arizona. If Democrats hold on to Arizona and pick up Nevada and keep it in the blue camp, that seriously undermines Trump's electoral college strategy. So they should be focusing on that. And I think time has run out on Trump being able to define himself in a way that's favorable to the majority of Americans on abortion, certainly with J.D. Vance's position. Secondarily, you mentioned early voting. 72% of early mail-in ballot requests in Pennsylvania came from the Democratic Party. What the Republican conference led by Trump and sort of the concerns over election fraud have really driven is a material tactical disadvantage in denigrating mail-in balloting, which allows the campaign to bank voters, get those people off your rolls once they've already voted, and focus on the people you need to turn out on election day. It's a tactical disadvantage that I think the Republicans have been screaming about for several years, but to no avail at this point.
Henrietta, but it also brings this possibility that Republicans can continue the line that they did in the last election, that it was rigged, that there were issues, if it was all mail-in ballots, that they weren't genuine. How concerned are you about a peaceful handover, not a handover, a peaceful continuation of power, I suppose, if Kamala Harris is the president?
You know, what's really interesting, and I heard this from Republican staff as long as a year ago, keep in mind why there was a delay in 2020 and why there was a delay in calling Nevada and upending the Arizona turnout or decision-making process. It was because of who was in office at the time. When Biden is in office, which he will be come this November, it's going to be a much more orderly process that adheres to what's actually happening on the ground. No one's going to be calling the governor of Georgia saying, find me the votes. So I think who is actually in office right now materially impacts whether this will be a smooth transition. I expect that it will be. You can claim that there was fraud, but it's going to be certified hopefully within the next day or two after November 5th.
Henrietta, given the fact that we haven't gotten a lot of policy proposals that people actually are taking seriously, I'm wondering how much you actually do think that the Federal Reserve is going to avoid cutting rates too much or too soon in order not to seem like a political agent. And I say this because in the absence of real policies, we have heard a lot from the Republican camp, from J.D. Vance as well as Donald Trump, about having a more political hand in the Fed, whereas the Harris camp is talking about not so much. How does that color your view of it?
Well, I think we have to focus on what's going to be happening next year. Extending the 2017 tax cuts is going to cost $4.6 trillion. I'm getting a lot of inbound questions from clients about whether there will be deficit reduction next year. There's no scenario where the deficit is reduced next year. There will be substantial federal spending. It'll happen as soon as September 30th of this year. I expect we will continue to get aid to Ukraine, albeit at smaller and lower amounts. Along with Israel, there will continue to be federal spending on par with what we've had in the past, which is about $1.7 trillion just to keep functionality. And then next year, we have to keep the tax bill extended. And I suspect that almost none of those tax cuts will expire. So the Fed is going to have to contend with some of the political stuff, but more importantly, with just the fiscal outlays that are going to be coming through, whether Democrats or Republicans win next year. So I think engaging with the Fed and trying to meddle from a political perspective, as somebody who was there when we did TARP and the auto bailout, and that's not what I want to see. You need the autonomy of the Fed. And I think that they'll fight tooth and nail for that.
Henrietta Treyz of Veda Partners, thank you so much. We're talking about the Fed and sort of the dynamic around it, as there's some real questions about growth. And we were talking about Home Depot and what's going on there. Torsten Slok, pretty much on cue, comes out with this. The media is full of anecdotes from earnings calls about the economy supposedly slowing down. But the reality is that firms on earnings call talk less and less about recession, Danny. In fact, we have never had a recession at the current low level of recession talk. See it again, chart below.
I would just raise Torsten Slok, Morgan Stanley, saying that they're talking about the consumer more than ever. So we'd be not concerned about recession, but certainly about consumer slowing down.
Or Citi as well, just publishing now. Rise in unemployment rate, plunge in ISM manufacturing suggests the U.S. economy may have already been in a recession.
Got that? All clear. Coming up, Alejandro Reynal, president and CEO of Four Seasons, as we take a look at the consumer, particularly the well-heeled consumer, and how resilient they have maintained, even as you see weakness in some of the tiers below. This is Bloomberg. A week of data really kicks off today with PPI coming in about an hour time. Good morning. Welcome back. This is Bloomberg Surveillance. What we're seeing in markets is not a lot. Basically, range bound as people parse through ahead of the economic data. S&P futures up almost 0.2%. NASDAQ outperforming once again the big tech havens, really highlighting their status as that. Meanwhile, Russell 2000 underperforming it again, down 0.2%. In the bond market, a real question here about whether people are getting over their skis with expected rate cuts and just how weak the economy is. You do see a 4% exactly on the 2-year yield, though flirting with going south of that. And 10-year yields lower as well, 389.97. But Danny, 200 basis points of rate cuts by the end of next year is basically what's being baked into the market.
And that is something that would be consistent with a recession, right? To cut by that amount. And most people aren't saying there's a recession. They're saying just that the Fed has room to cut by that amount. But what signal does it send if a Fed were to cut something like 100 basis points this year in an environment where there's not a recession? That means that going into data like CPI, perhaps the risks are skewed, that if it surprises to the upside, there's only one direction for bonds to go, that there is a clear pain trade in this market if we're pricing in so many cuts.
There have been plenty of pain trades. They've all been executed, basically. We're looking also at the potential of what that means for the dollar. Does that mean dollar strength? Mark McCormick of TD talking earlier that he sees that sort of over-exuberance about rate cuts getting priced in today. A little bit more strength in the dollar than we've seen over recent sessions. Euro falling just a touch, basically flat, 109.27, as people try to reset the balance of risks. Under surveillance this morning, U.S. officials saying they believe an Iranian attack against Israel has grown even more likely and may come as soon as this week. White House spokesman John Kirby telling reporters yesterday that the U.S. and its allies have to be prepared for what could be a significant set of attacks. Anne-Marie, definitely really keeping high alert pretty much across the world.
Yeah, so the United States is basically saying the Israelis think it's coming. We agree with that assessment. Remember, in April, Iran sent over hundreds of ballistic missiles. Most of them were intercepted, and they were able to the United States, along with Israel, able to fend this off. What is concerning now is that maybe it's not just going to be Iran, but it's going to be Iran plus Iranian-backed militias. How much harder will it be, not just to have the defense, but then to set a standard of deterrence? And I just think, besides what the White House is saying, look what the DOD is doing. The movement of forces into the Middle East, including USS Georgia, a submarine equipped with more than 150 Tomahawk missiles. So clearly, they're either getting set for two things. One, this could be an act of deterrence to tell Iran, do not go here, or this is for pure defense.
And that's the reason why a lot of people keeping a clear focus on this. We will be providing you updates throughout the day. Meanwhile, General Motors cutting jobs in China. Sources telling Bloomberg that the company will meet with local partner SAIC in the coming weeks to plan a larger structural overhaul of its operations there. Danny, a real question here about just how much U.S. companies in general, multinational companies, can continue expanding in China, or how much they've got to retrace with a lack of visibility in how business-friendly they're actually going to be to international companies.
Right, exactly. Not even just that, but how do you compete in a market that is flooding itself with not just EVs that American and other international companies are having a hard time keeping up with, but cheap ones? By all accounts, something of a price war happened in China, where you saw the likes of Tesla having to cut their prices too. So how do car makers keep up with that when you have to worry about geopolitics, local players, and the cost, and the fact that a lot of them are behind on technology? And China's quite ahead with things like over-the-air updates. It's almost an existential crisis for GM at this point.
Well, and certainly other companies are trying to parse out what they can do, what they're going to do quietly, what they can actually say on the record. Meanwhile, traders awaiting U.S. PPI due at 8:30 Eastern. Our survey expecting headline producer prices to increase 0.2%. It's basically in line with what we saw in June. Core PPI growth likely slowed to 0.2% from June's 0.4%. Key question here is just whether the inflation will come off enough to give the Fed some room to cut rates. Turning to travel, and really this is the reason why we wanted to highlight travel this particular week. We're seeing a real discrepancy between high-end travelers and low-end travelers in terms of their position to spend. Is there a change in that? Four Seasons CEO Alejandro Reynal saying his company has seen its strongest year ever, writing this: short-term uncertainty given the current geopolitical and macroeconomic pressures are impacting traveler sentiment, but the luxury segment is more resilient. Alejandro joins us now. Alejandro, thank you so much for being with us. Pleasure to have you here in studio. I want to start there. Is it true that you're not seeing any slowdown whatsoever in the luxury element?
Good morning. Thanks for having me. It's a pleasure to be here. And I love the fact that we're talking about luxury hospitality. Yes, I mean, we had a really strong first half of the year compared to last year, much better. When I look into the booking trends for the second half of the year, even going on into 2025, they look very strong as well. You know, I think there's two things that are happening there. First and foremost is that the luxury guest or the luxury consumer continues to be very resilient. They continue to spend, you know, that desire for experiences, to explore, continues to be there. But also I would say that from a Four Seasons angle and from a Four Seasons point of view, we do offer a very clear value proposition to our guests. I mean, we do have, very proud to say that we have the very best hotels in the best locations, and we provide the best service to our guests. And when you have that as the brand proposition, and that's what we do at Four Seasons, there's a demand for that. And by the way, this is not new of this year. We've been operating now for 60 years, and that has been the constant all throughout the period.
So what has changed? And I'm wondering not just from the consumer who's able to spend, but also from the employees and who you're able to recruit. For a long time, there was this dearth of people willing to work in hospitality in the direct aftermath of the pandemic. Do you see it as being much easier now to hire people and sort of easier to also retain them without massive price increases, wage increases?
Yes. I mean, obviously for us, a key component of what we do is through our people. I mean, we are a service company, and the most important asset is the people that we have with us. So we place a lot of emphasis in making sure that we are the employer of choice in every single market that we operate. We do spend a lot of time training people, developing them. For us, we do measure employee engagement twice per year. We are at the 2% across all industries in terms of employee engagement. So it's a topic that we spend a lot of time because we do believe that we need to have the best and most engaged employees with us. We haven't had, I mean, obviously, right after the pandemic, there was a little bit of pressure from the labor point of view. We don't see that anymore. But again, it's because of the efforts that we place in making sure that we are the employer of choice in the markets in where we operate.
I want to know more about your customer, but specifically like the ultra luxury. And there I know you have a private jet service, something like $115,000 for a charter a day. Yeah. How much demand is there for that?
Yes, you know, it's interesting. And just to give you the context of this is, obviously Four Seasons started as a hotel and a resorts company, and we are now the leading luxury hospitality company. And that's where our guests experience the brand. What we found over time is that because our second business is the residential, branded residential, so guests, they stay with us, they experience the brand, and then they are willing to buy a residence with us. So that's sort of the journey that they start experiencing with Four Seasons. And then the third piece is what you just said, is the journeys, experience-based travel that we promote as a third line of business. So if you think about the whole analogy, guests, they stay with us, they live with us, and they travel with us. They develop such a comfort with the brand and with the brand promise and the brand proposition that they're willing to spend that amount of money in traveling for 20 days through 10 Four Seasons in Africa or in Europe and so forth. So For us, it's been more around creating this luxury ecosystem for Four Seasons that our guests are eager to travel. By the way, we have all the itineraries for this year sold out for the rest of the year. So it's a very successful product, but again, it taps into that desire to experience, to explore that we find in our guests.
So you're saying we're too late for it then?
Yeah, 2025, we're opening
Good to keep in mind. I mean, just talking about the different mix of your businesses, you're not the only one doing it in this space, and it obviously is an exclusive space of those who can offer this. But you think of, the Amman resorts also trying to give also experiences to. What does competition look like right now?
Mm-hmm. Well, competition, because of the attractiveness of the luxury space, there's a lot of competitors coming in. I think we have, as a Four Seasons, the advantage of the brand. I mean, we are the most, we continuously measure brand preference, brand awareness in terms of our brand, and we continue to be the #1 luxury hospitality brand. And I think that carries a lot of weight, but it's because at the end of the day, we're able to deliver that value proposition to our guests. I mean, it's interesting because I do interact with a lot of our guests, and when I ask them what do they like about the Four Seasons, the first thing they tell me is that I know what to expect. And I've been able, as a guest, to explore remote destinations. So, for example, I've been able to go to Bora Bora, but because there's a Four Seasons, I feel comfortable because I know what to expect. And to have that level of consistency and that brand power is very, very unique. So I think we're uniquely and very well positioned.
Where do you see the demand right now in terms of the hot spots, top 5 people are traveling to?
Yeah. It's interesting because, and I'm going to say something which is a little bit contrarian. When I look into the history of Four Seasons over the last years, travel patterns haven't changed much. For example, 55% of our revenues come from the Americas, the majority being the US. More than 50% of our guests, they are from the US. And where do they travel? To the US. Right now, during the summertime, they travel to our South Florida collection, they go to Hawaii. Beyond the US, they go to Mexico and then Europe. The fact is that, and this has happened for many, many years, Americans are going to go to Europe probably once a year, every summer. I mean, that's, so, and we're seeing that again this summer, but it happened prior year. So, but again, America is representing 55% of revenues. For us, EMEA, Europe and the Middle East represents 25% of the revenues. And there the dynamics are similar. Europeans, they mostly stay within Europe. They venture into the Middle East or Africa. And then we have APAC, which is 20% of our business. 3% is only China, and that's mainly regional travel.
Do you still see the Chinese consumer spending as much in luxury hotels the same way the U.S. consumer is?
No, they have not come back. I mean, when I look into what was the spend prior to the pandemic, it's less. It's interesting because they are spending less in China, so we still don't have the same rates that we used to have prior to the pandemic in China, but they are starting to spend more internationally, but internationally within the region, meaning Japan for the most part. Because of visa issues and many other things, they still have not come back to Europe or the US, which is where we saw them prior to the pandemic.
There's a real question here about how much, and Torsten Sklock of Apollo called us out for us this morning. He said, all you people in media, and I'm paraphrasing, just keep using everyone as an anecdote to try to paint a macro picture. Your company has been around for 60 years. Yes. How independent of the macro cycle is it, right? I mean, because are we talking about something that is a complete microcosm unto itself of people who have disposable wealth and are going to travel no matter what, versus a company that does have some sort of sensitivity to what's going on in the underlying consumer sentiment?
Yeah. I mean, I would be lying if I would say that we are immune to any macroeconomic geopolitical impacts, because we are. I mean, at the end of the day, that uncertainty impacts traveler sentiment, and people don't travel because of that. But obviously, we've been operating for 60 years, and we've gone through these cycles, and they go away. And at the end of the day, what we see is year over year that the market continues to grow. I mean, travel and tourism has been growing for many years now. That desire to experience, to explore continues to be there. I think it's really interesting when you look into the luxury consumer that our composition of guests, about 20% are boomers, 45% are Gen X, 35% already are millennials. So that transfer of wealth is starting to happen, but we're not losing the boomers. So it means that the market is expanding. So always, year on year, there's going to be more demand, more growth. And at the end of the day as well, we as a hotel and resort company need to be at the forefront in terms of creating amazing experiences so we can satisfy the demand. So I don't think at the end of the day that the demand just comes by itself. We need to have, like we do, a very special product, a very special service proposition to our guests. So at the end of the day, they are eager to come to a Four Seasons.
So you're doing great with the baby class. I hear that you're really, crushing it, particularly south of the U.S. Paid actor?
No, it wasn't. But that's one, it's a tremendous learning experience because sometimes you spend so much money on marketing that doesn't provide any outcomes. But then these special, authentic moments are the ones that the consumers value the most. This was a complete viral moment, but it was completely authentic. We had nothing to do with it. In the end, we had more than 300 million views through various digital platforms on the Four Seasons Baby. Obviously, we got a spike on on searches on Four Seasons Orlando. So it was very good. But again, it was very authentic, which ultimately is what people like.
I love it. I wonder how many board meetings were about the Four Seasons Baby. Alejandro Reynal, Four Seasons CEO, thank you so much for being with us. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Israel's sovereign debt was cut by one notch by Fitch Ratings, which kept a negative outlook on the credit as continued military conflict weighs on the country's public finances. According to a statement, the ratings firm lowered the country's score to A from A+, citing continued war and geopolitical risk as drivers. The analysts said, in their view, the conflict in Gaza could last well into 2025, and there are risks of it broadening to other fronts. The NFL is meeting with a handful of private equity groups this week. According to people familiar with the process, it's a step towards opening the league's ownership ranks to institutional money. The meetings are intended for the league to conduct more due diligence, but also to talk through potential policy preferences. The NFL is the only major U.S. league that doesn't allow institutional investors. It has spent more than a year observing results from other leagues and discussing what it might do differently. And Alphabet investors are anxiously awaiting a Google hardware event today, hoping new AI features will help stop a sell-off that's wiped out more than $360 billion in market value in just 1 month. Google is unveiling one of the biggest redesigns of its Pixel phones in their nearly decade-long history. Alphabet is also expected to reveal on-device AI offerings driven by Gemini's large language model. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, raising cash ahead of the data.
We are looking at the curve to steepen, but we have to be very mindful here about what economic scenarios we're taking into account when thinking about the yield curve, because it is very much so hard landing, soft landing, no landing dependent.
That's coming up next. This is Bloomberg. Everyone is still planning their vacations for the remaining couple weeks of the summer. Welcome back. This is Bloomberg Surveillance, taking a look at a market that is reflecting the fact that most people are on vacation. Up 0.2% in the S&P, just really going nowhere. If you look at the currency markets as well as in the bond market, you're seeing a little bit of a retracement in crude after a 5-day winning streak that led to yesterday's rally, which was one of the biggest going back to November. Under surveillance this morning, raising cash ahead of the data.
We are looking at the curve to steepen, but we have to be very mindful here about what economic scenarios we're taking into account when thinking about the yield curve, because it is very much so hard landing, soft landing, no landing dependent. When we have greater conviction in the harder landing outcome, there's no absence of demand for Treasury securities.
And maybe just not Treasuries. Here's the latest. More than a dozen companies tapping the investment-grade credit market, hoping to raise over $18 billion and making the offers before key inflation data this week. Matt Brill of Invesco writing this, potentially a buyer, evidently. After major volatility, yields still look reasonably attractive for IG bonds, yet spreads no longer look rich. It's been a wild ride for rates and credit spreads, yet our expectation of a soft landing still holds. Matt joins us here. Matt, great to see you. So have you been hoovering them all up, all these bonds that are being sold by the companies?
We have. We've been very active. It's been incredibly busy last few days, really starting on Wednesday of last week. And you just saw just a continued issuer after issuer coming to the market. And we look at all-in yields, they're still north of 5% for the investment grade market, and that's attractive. But there were so many complaints for the last several months that spreads were just so tight and that nobody wanted to buy them because spreads were so tight. But all of a sudden, you've got a little bit of a sale going on within the investment grade market.
I guess there's a key question here. We did see spreads blow out quite considerably in last week's turmoil. They haven't retraced, as you say. They don't look quite as rich. They're still about 1 percentage point. Doesn't this, though, raise the issue that if you do get more weak data, you could see that really be reflected in credit markets more than people were really saying earlier this month? Yeah,
so we're absolutely in the bad news is bad news type of market now. So maybe a year or so ago, if you got bad news, you could think, okay, maybe that means less inflation. But now it really does mean potentially fundamental problems. But we're not really seeing that. So we actually still think spreads where they are. Yes, they're not compensating you for a recession, but we don't think there's a recession that's going to come. So everybody wants to wait for the river card to get played and then say, okay, well, now I can go place my bets. But that's not how the market works, right? So we're trying to look ahead, and we do think that even with this hiccup last week, we're still on the track for the soft landing.
How much, though, does it make a difference that you have a high-yield market that is much better quality than it once was? If you're thinking about a typical sort of growth scare playbook, does it look different this time around?
We think so. So if you think about what's happened within the high yield market, you have a lot of private credit that's taken away a certain portion of that market. You also have bank loans that have taken away other portions of the market. What's left is generally the highest quality double B type companies. So it's not your father's high yield market, if you will. You're also seeing that in the investment grade market, where the lowest portion of the investment grade market is only about 10% or so rated triple B minus. So on the verge of potentially going to high yield. So if there are problems, we think the market is better set up to handle that. And that's partly reflected in spreads. But just overall, we just think that tail risk is significantly less than it probably was, just 5 or 7 years ago.
Even so, the flows have had a clear divergence just the past week, where you have high-yielding funds seeing outflows for the first time in some time, and then high-grade continues to get just an amazing pace of strong inflows. Do you expect, again, just because of the sentiment of this market, that divergence to continue?
So I think high yield will come back if you get a little more stability in the market. I think just given the shock that you saw, it's sort of hard to jump right into the high yield market. But overall, once you stabilize and you look at high yield, where it's trading from a yield standpoint, it's going to look pretty good if you believe that we're not heading into recession, which we still need to see a few data points, I think, to get people to believe that. But again, go back to investment grade. It's mainly been an institutional buying spree for the last several months or really several years. But within the last week or two, we're starting to see the retail market pick up. We're starting to see, we had advisors meeting with us yesterday from Miami up here in New York. They're saying we want to get our investors out of cash and out into term debt. And we're afraid to do it into high yield, but investment grade at 5%, that's the number, that's kind of the holy grail we were looking for so long. We got there at 5 and everybody said, we're going to 6. So I don't know if I want to buy. Now that we've gone to 6 and back, I think people are saying if the next stop is 4, I need to be owning it now.
Buying American high yield and bonds and then steering clear of anything inflation insensitive, is that the credit's version of a Trump trade?
I think it's a credit version of just not having a disruption to the overall market. So whether that's a Kamala trade or a Trump trade, I think at the end of the day, it means that, we are going to see growth in this economy. We, at the end of the day, we think that, regardless of the election, we're going to see growth. And so, if you get a split government, that probably makes, for a little bit better for the Treasury market, for credit markets in general. We actually think both candidates are setting up well in that regard. So I don't think you have to really term it anyway. I think you just say, it's a soft landing trade in the U.S. that won't be disrupted by politics.
But you think either candidate will be good for credit, even going to 2025? If we see higher inflation potentially?
And it's because the fundamentals are set up well. From the foundation standpoint, you're seeing where balance sheets are. Companies have not overstretched. If we were going back to 2008, 2009, obviously, companies had a lot more leverage in their balance sheets. Companies have been preparing for this recession. It's finally to the point where people are no longer expecting the recession, maybe a little bit. But for so long, people were expecting this recession that never came. And so balance sheets were really good order in order to prepare for that.
We didn't use a word that starts with I. We didn't talk about inflation at all. Is that basically out of your picture right now as a concern?
Well, I'm concerned because it's the only thing that could really disrupt this Fed put that we think is in play. If you see a 0.3 tomorrow or even today with PPI, but if you see a 0.3 month over month CPI, I think everybody's going to pull back and say, the Fed was going to have our back, but maybe they won't. If it's 0.2 or 0.1, I think you have a very clear path here.
So what's the trade if it does surprise to the upside?
So if it surprises to the upside, you've got to be shorter on the curve. You've got to stay in T-bills, which I think is not the trade that we have on, but that would be the trade that would do better.
Which is the reason why so many people are hooked in right now to what this data today and tomorrow's show. Matt Brill of Invesco, wonderful to see you as always. Thank you. Have fun hoovering up all those bonds that keep getting sold ahead of that data. Coming up next hour, we've got Keith Lerner of Truist, Bloomberg's Craig Trudell, Matt Luzzetti of Deutsche Bank, and David Rubenstein of the Carlyle Group as we parse through. Right now, it looks like a pretty sleepy week, and yet it seems like there could be, Danny, some sort of catalyst, particularly when it comes to the inflation data.
Totally. Is this just calm, or is it just the eye of the storm? Is this a market that's resilient, or is it a market that's complacent? You could argue the latter if it is a scenario where we've just gone right back around with everything from bonds to equities, leaving us once again vulnerable to big market shocks should the data surprise.
Which is a reason why people are expecting more volatility ahead, even if you're not necessarily seeing it this morning. This morning, a calm, maybe ahead of the storm, or maybe just calm. Taking a look at S&P futures, up about 0.2%, going nowhere in the bond and currency space. This is Bloomberg.
The equity market has been posting excellent returns, right? And so you're at a point now where you need to take a breather.
We are very much ready for volatility.
I wouldn't be surprised if the volatility continues for a while, even through the fall.
The market was far too excited a week ago in pricing in too many Fed interest rate cuts.
This is a harder environment than markets were, say, 3 months ago.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get the data started. 30 minutes away from U.S. PPI, kicking off a week that could potentially give a sense of how much ammunition the Fed has to cut rates. Welcome back. This is Bloomberg Surveillance. Anne-Marie Hordern, Danny Berger, myself, Lisa Abramowitz, John Ferro off this week on vacation, which is well-deserved. I'm not going to call it a sabbatical and tease him, as some other people might have done. Right now, taking a look at markets quiet ahead of 30 minutes time when we get, Danny, U.S. PPI.
And I'm also interested that the Home Depot earnings didn't dent sentiment more than it did, because initially you did see ever so slight of a pullback. We are rallying yet again. And this seems to be one of the things that the market is craving, more evidence of how bad the consumer slowdown is. If it is just the lower end, if it is bleeding to the upper end, Home Depot serves a wide breadth of consumers. But maybe, Lisa, it goes to the point that we're assuming that this is just about housing and it's not bigger weakness.
Maybe this also is because Torsten Slok came out and said the media is full of anecdotes from earnings calls about the economy supposedly slowing down. But the reality is that firms on earnings calls talk less and less about recession. To me, the question really ultimately becomes, how do you price in a soft landing? How do you price in a weakening when that is fully priced? Is that sort of a risk that has been overweighted at a time where there clearly are some other uncertainties?
I think what Torsten's getting at is when CEOs come out and they say, we're seeing some softening, but we're not soft. And this goes back to the Bank of America survey, shaken, not stirred. Basically, 76% of respondents are saying we still maintain there's going to be a soft landing. But the second Torsten Slok published this, we got a note from Citi's Andrew Hollenhorst, who said the rise in unemployment rate and plunge in ISM manufacturing suggests the U.S. economy may already be in a recession. There is a serious debate right now about where we are in this economic cycle.
Here's the rub, and this is the reason why in 28 minutes' time, when we get PPI, it's going to be really crucial. Danny, and we heard this from Matt Brill just a second ago. Essentially, he's betting on this soft landing. He's buying credit. He's buying bonds. He's seeing some optimism. Because inflation isn't a problem, should PPI come in hotter than expected, how much does that unravel some of the optimism we're seeing in markets?
And then they might need to start paying more attention to the Fed, because we could argue for the most part they're not paying attention to the Fed, with many members saying we aren't there yet, not for 50 basis points of cuts, but just for 25. So if PPI comes in hotter, if that sets us up for a hotter CPI, does it need to be, again, the pendulum swing, already having swung, I don't know, maybe 50 times in the last week, need to swing again to inflation is a concern, and the Fed can't cut yet.
Yeah, and it's hard to know what to focus on, honestly, because when you take a look at some of the headlines, really the ones that are dominating have to do with the consumer and just basically offsetting that potential risk of a much deeper slowdown. It's not necessarily the geopolitics of the moment, Anne-Marie, even though they are highly concerning to a lot of leaders across the world.
Absolutely. Geopolitics at, peak it feels like this week when you see the USS Georgia moving into the Gulf, you see Tomahawk missiles from the United States, this defensive position almost the U.S. is setting up, because what they said is that Israel is telling them that Iran will be retaliating soon, and they have those same concerns. But at the same time, Amrita has said, and what we've seen over the course of the past few months is supply hasn't actually been hidden. So then it comes down to the basic fundamentals of the oil market of supply and demand.
Which really, and if you take a look at markets, that's what you see reflected. Right now, you see a bid into stocks, as you were mentioning, Danny, retracing some of the gains that we saw earlier before Home Depot released their earnings, up about 0.3%. Euro dollar going basically nowhere, flat. 10-year yields marginally lower, and crude, AMH, to your point, lower on the day, down 0.7% as the supply-demand dynamics trump some of these bigger geopolitical concerns that very much are looming. Coming up this hour, Keith Lerner of Truist, as markets await crucial U.S. data. Bloomberg's Craig Trudell as General Motors shifts its strategy in China. And Matt Luzzetti of Deutsche Bank on his continued call for 3 rate cuts through the end of the year, once thought to be too much by the market participants, now considered basically lower than what traders are pricing in. We begin with the big issue, stocks on hold, ahead of PPI out in just under 30 minutes. Data that will help confirm potentially soft landing hopes. Investors optimistic about the Fed's path forward, and despite recent volatility, enthusiasm for mega cap tech remains. Keith Lerner of Truist upgrading the sector back to overweight last Thursday, saying this: risk reward has improved for the tech sector. Moreover, in a cooling and economic environment, we expect investors to come back to tech, given some of the secular tailwinds stemming from AI and its premium growth prospects. Keith joins us now. Keith, this was a dip that was buyable. Why, in your eyes?
Yeah, well, first, great to be with you. It's nice to see a little bit of calm for a change. So with tech, we would have been bullish all year long, but towards the end of June, things got a bit more speculative. We saw most of the last run up being more valuation expansion, and we saw the greatest 1 month outperformance relative to the S&P since 2002. So we said, this is not the time to get in. We think we have a better opportunity. Last Thursday, as we upgraded and moved it back to overweight, we saw the rubber band move back the other way, meaning we had the 1 month, the greatest 1 month underperformance since 2002. At the same time, as we dissected the pullback, it was all, kind of reposition and valuation contraction. Earnings for the sector continue to make new highs. And as we move into the fall, we think the narrative will shift back to, Apple's new iPhone and potentially a new PC upcycle as well. So all in all, especially in a cooling economy, we think investors will come back to tech.
This is really a compelling debate right now, because we've talked to some market participants who actually are arguing the opposite, that equal weight has just started to rally and really catch up to big tech. And yourself saying maybe the opposite, in the way of, big tech will continue to lead. What is the economic backdrop that has you calling for tech outperformance?
Well, we do think the economy is still growing, but it's certainly slowing or cooling. And I think in that environment, we're thinking about more like trend growth around, 2%. We think the Fed is, by almost all measures, still restrictive. So we think they need to get going. And I think in that environment, whether there's a lot of debate whether we have a slowdown or recession. We're in the slowdown camp. But either way, it feels different than the last few years. So I think investors will look for kind of like these secular tailwinds that will persist. And we're still seeing that spending happening, in tech on AI. And then if you look more recently, even on the balance, look at, small caps we still have a position in equal weight, but I think we're going to start moving from broadening back to narrowing again is our view, because you're seeing those relative price trends actually start to move down again in these other areas outside of tech. So we think tech is going to be a good place to be for the remainder of the year.
Keith, how much, though, of these hyperscalers spend, of, Amazon talking about spending $600 billion in the year in CapEx, Meta as much as $40 billion, how much of that is acyclical or depends on a growing economy that can generate cash in other parts of these tech giants' businesses?
Yeah, well, I think there's a bit of an arms race that some of these companies, they're going to have to continue to spend money even if the economy slows down, because it is an arms race. So I think that will continue. And then I think as you kind of go down beyond the hyperscalers, you're going to probably see these kind of add-ons to other, the software or like software players where companies will tack on 3 or 4% to use their AI features as well. So I think that will be a slower move, but I think in general you'll see that. And of course, we'll be proven probably right or wrong by the end of the month, because we have the biggest report of this month, I think, which is NVIDIA at the end of the month.
How are you thinking preparing for that? If you look at a corollary, Supermicro Computer, who is a big customer of NVIDIA, strong revenues, weak profit, and the shares were just destroyed, Keith. How sensitive will we be around a much bigger company, NVIDIA, at the end of the month?
No, I think it will be a big report for all of tech and for the overall market, because we know tech is such a big part of the S&P 500. I think at least, one of the reasons, again, why we had downgraded in June tech is that expectations were too high. I think at least the good news is semiconductors as a whole are down about 20% off their highs from June. The tech sector is down double digits. So at least the bar for positive surprises is somewhat lower. Of course, we'll have to see what happens between now and then. But also, as you look at the other hyperscalers, how much they're still spending in CapEx, our expectation is that the overall report will come in, reasonable. Of course, I can't give individual recommendations on stocks, but if you look at the other reports, it suggests that CapEx cycle has further to go.
When you look at NVIDIA specifically, and I guess big tech overall, you said that you're overweight for the rest of this year. How concerned are you about 2025? I think of antitrust issues, given what J.D. Vance said even just over the weekend. I think of a story this morning from the Wall Street Journal about how Huawei is looking at a new chip because of sanctions with the United States, and potentially that new chip is going to mean less of a NVIDIA sale in China. How do you think about all these concerns on big tech specifically for 2025?
Yeah, it's certainly a risk. And I should probably provide a caveat. I mean, that's our base case as far as what we think now, but we're going to follow the data. We're very weight of the evidence oriented. And one of the reasons why we had somewhat of confidence to upgrade the overall sector is that we saw the earning trends continue to make all-time highs the last few weeks. So what would get us more negative, even into 2025, if we saw those earning revisions start to turn negative? Right now, they're positive. And as I mentioned, even if we slow down, I think investors are going to look for some, where there's secular growth and where things can hold up on a relative basis. But obviously, there's a lot of different parts of the industry, trying to bring in more competition as well. So we'll look at the data and have that, lead us. But at this time, we're not seeing any signs of cracking in the earnings picture.
Keith Lerner of Truist, thank you so much for being with us. Some breaking news, actually. Starbucks is replacing its CEO effective immediately, looking at naming Brian Niccol as chairman and CEO. He is currently the head of Chipotle. He's talking about Starbucks naming CFO Rachel Ruggeri to serve as interim CEO. Meanwhile, you're seeing CEO Laxman Narasimhan stepping down effective immediately. You're seeing Chipotle shares down 8.7% on this news, given the surprise departure. And you're seeing Starbucks shares up more than 10.7% on what we're hearing. Meanwhile, this is coming as activist investors have been pushing for changes. And we're talking about the potential for rejiggering a company that has really struggled in the face of geopolitical pushback, as well as just people not buying maybe vanilla lattes. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackis.
Hi, Lisa. Johnson & Johnson has cleared a key hurdle for advancing a $6.5 billion plan to resolve thousands of lawsuits by people who say its baby powder gave them cancer. According to people familiar with the matter, more than 75% of the group signed off on J&J's proposal through secret balloting. The settlement offer includes claims that the talc-based version of its powder caused ovarian and other gynecological cancers. Under J&J's current offer, it would make payments for current and future claims over a 25-year period. According to a global survey by Bank of America, the volatility in global financial markets hasn't derailed investor optimism around tech giants or expectations of a soft landing. The poll was conducted during the height of last week's turmoil and showed a defensive rotation into bonds and cash and out of equities. But long bets on the Magnificent Seven remain the most crowded trade, albeit less so after the sell-off. And Home Depot lowered its full-year sales outlook, signaling that it expects consumer spending to remain soft in the coming months. The company sees comparable sales falling 3 to 4% for the year versus the previous expectation for a 1% decline. The disappointing results come as consumers have held off buying homes or pursuing big renovations amid high interest rates and macroeconomic uncertainty. Comparable sales also came in worse than expected, falling for the 7th straight quarter. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Just going back to this breaking news that Starbucks is replacing its CEO following activist investors pushing for changes. It also comes after the shares of Starbucks have been down some 19% so far this year. Danny, you're looking at Chipotle shares up more than 22%.
I think it's really telling that they went to Chipotle to get their next CEO. The former CEO of Chipotle, to your point, going to be serving as the next Starbucks one, because this is about a consumer that is getting more picky. What are they picking? They're not picking Starbucks. They are picking Chipotle. So potentially internally at Starbucks, they say this isn't a consumer problem. This is a strategy problem, and we need to change something.
How do you convince people you're giving them value in the same way that can give them small luxuries without breaking the bank? We'll discuss that more coming up. But also up next, the morning calls, plus Bloomberg's Craig Trudell as General Motors overhauls its operations in China. That's coming up next. This is Bloomberg. Still parsing through this story about the Starbucks-Chipotle nexus, given the fact that Starbucks is just replaced its CEO with the former CEO, evidently, of Chipotle, looking to reprise some of that. Danny, you were making this point. It's sort of a similar customer base in terms of who they're trying to appeal to.
Right, exactly. But it's a customer that's become more picky. And I think you said it really well. What can you appeal to them to give them the small luxuries? It's, at Chipotle, apparently, it's filling your burrito bowl literally as high as possible. So what sort of value proposition will Starbucks now offer to get those people to keep coming back? Because they've been trying a lot of stuff and a lot of different strange flavored drinks.
Well, the value proposition of the new CEO is a pop in the shares this morning. Time now for the morning calls as we look beyond just simply Starbucks and Chipotle. First up, Bernstein downgrading Warner Brothers to market perform. The analyst pointing to disappointing Q2 results and frustrated investors. Next up, Citi upgrading Hormel Foods to buy. The analyst seeing upside to earnings estimates due to strengthening retail trends. And finally, Stifel raising its price target on Walmart to $73. The firm citing positive consumer spending intentions and Walmart's increasing share of grocery purchases since 2019. Turning now to the auto space, we've got GM struggling in China like many other international companies. Bloomberg reporting that the U.S. automaker has been laying off staff in China and will soon meet with local partner SAIC to plan a larger structural overhaul to its operations. Joining us now is Craig Trudell of our Bloomberg Bureau. Craig, just want to start with how idiosyncratic is GM versus this broader retracement of international companies that make cars in China?
I think this is really a broad story here where if you're not a Chinese manufacturer, you're not doing well in China. It's as simple as that. I think, when you look at General Motors and Volkswagen in particular, these are two companies that have been in China a really long time and managed to really gain traction in that market for decades. It's very quickly, gone sideways for these companies. And, manufacturers that have had smaller presence in China, they too are not doing well, but, they had less to lose. And so, GM and Volkswagen in particular, I think, have, really significant presence in that market, a lot of employees and a lot of plants. And they're going to have to answer some hard questions in the coming months and maybe years, undoing their presence in this market. Assuming, of course, the trends hold, which, when you take a step back and look at what's happened to these companies' sales just the last few years, it certainly is not inspiring a whole lot of confidence.
Well, for so many of these companies, realizing that they couldn't go at it alone in the Chinese market, they did these JVs. And of course, GM being an example of them, starting this JV in 1997 with a 30-year contract set to expire in just 3 years' time. Craig, is it a matter of even a JV can't save you, that you can't really be in this market alone or with a partner?
I think it's a really great question. And I do think it's a case where, you had local companies, in the case of SAIC, this is a state-owned company that we're starting from scratch and really could use the expertise of, a company like GM or Volkswagen, which, by the way, SAIC is partners actually with both of these manufacturers. They don't necessarily need that expertise anymore. They've been around long enough. They've learned quite a bit from the companies they've partnered with. And they also, by the way, have, sort of internationally recognized brands. SAIC owns MG, which is a British brand that collapsed, decades ago, and was kind of scooped up by SAIC, and has really, they've really, to their credit, done a heck of a job, building that brand back up. Not only in China, but here in the UK and in Europe. It's one of the more successful brands owned by a Chinese company in Europe. So it is the case that these Chinese companies have really over time developed their own expertise and ability to manufacture, and it really feels like they've sort of surpassed the domestic or the international companies that they've partnered with for years.
Do you think this is the floor for laying off some of the staff? I mean, it's a huge reversal for GM in terms of their strategy in China. Or do you think we can see even more layoffs?
I think the way that Mary Barra has been talking about this, she's said that this is, unsustainable. The state of the market in China is unsustainable. And, I guess the question really is how much longer can this, price competition that she's referring to there can continue if GM is just counting on the idea that this, pain is going to last and people leave until people leave the market. I think, looking at what they've been saying, they want to really recalibrate, get much smaller in that market, and sort of wait and see until this shakes out, because they're looking at the way that companies are performing in that market. As much as a lot of Chinese companies are growing, not all of them are doing so profitably. And so, do you see some consolidation and find a path while some of these companies that maybe can't play this game forever fall by the wayside? That seems to be the play here.
Craig Trudell of Bloomberg, thank you so much for being with us, as always, and for the insights. Meanwhile, we are about 8 minutes away from U.S. PPI. Joining us now, Michael McKee, Bloomberg economics editor and policy correspondent. Mike, I do want to start with just how the market is currently poised. It seems like everyone we're talking to is almost discounting inflation and thinking that a hot PPI or CPI print is merely an inconvenience but doesn't shake the trend.
I think if we get a hot CPI, it might change some investors' minds or views about how soon the Fed goes or how far they go. But at this point, we're not expecting that. The PPI always a wild card because it has a lot of different moving parts mostly people think about it in terms of inputs into the PCE indicator because it doesn't directly reflect what's going on with CPI. Interesting thing about last month's PPI is that the whole rise was in services, and almost the whole rise in services was in trade services, which is wholesaler and retailer margins. They went up almost 2%, which gives you some clue about what we're seeing in the earnings this quarter is that companies are reporting margins that are okay, even if their sales aren't good. And that's going to be an interesting thing to watch going forward.
And that is one of those things that feeds into PCE, right? Financial services. For those various metrics that do feed into PCE, what are the expectations for them?
Well, we don't know about financial services. We've had a fairly quiet period during the month of July. It was August where we saw the ructions. So we'll see if there's a big change in that. Airline fares went down a little bit during the month, so that could show up as a decline. And then there's always automobiles. That's going to be a funny category because we had the problems in June with the hack of the auto sales computer system, and they couldn't sell as many cars, so did they discount in July? That'll be interesting to look at. Medical care services, that's one that everybody wants to look at. Everybody, economists want to look at, so we see what goes into PCE.
But for PPI, you say the main takeaway, bottom line, is this matters because of PCE. So really tomorrow, it's CPI that everyone is focused on. How much do you buy into this that if we get, say, hotter than expected, even 0.1% higher than the 0.2% that the market, the survey is expecting, that would be very difficult for the Fed to potentially cut in September?
It might make it more difficult. We heard people like Mickey Bowman the other day, the Fed governor, saying that she's not convinced yet that inflation is durably coming down, and that would feed into that narrative, and anybody else who's sort of in that path might agree with her. It might put us behind. We're also getting into a time of year when base effects are going to start affecting the year-over-year numbers, and so a small move in the month-over-month could mean that CPI goes up on a year-over-year basis, which the Fed as economists would look past, but would be very hard to sell to the public or to Congress.
Mike McKee, please stay close because we are going to be digging into those medical expenses really closely. Coming up next, as well as the other components of PPI. Expectation of the Bloomberg survey is for a 0.2% gain in PPI. That is in line with what we saw in the prior month. This comes ahead of CPI, with also a 0.2% gain expected for the month. We're getting that tomorrow. Coming up next, we'll be breaking that down with Matt Luzzetti of Deutsche Bank, who will be here to react. This is Bloomberg. 25 seconds until we get the first round of the key economic data of the week, U.S. PPI. Heading into that, we see markets very quiet, although building on the gains from earlier in S&P futures, up 0.4%. You could see bond markets also just starting to get basically complacent with the idea that inflation is coming off the hilt. Two-year yields now solidly below 4%. With that economic data, here in the studio is Michael McKee. Mike, what do we see?
Well, producer prices are up less than anticipated, just 0.1% on the headline final demand number, and the core is flat. Now, we had expected a 0.2 rise for both of those categories, so overall, that is good news and certainly a turnaround in the core number, which was up 0.4 in the month of June. Now, on a year-over-year basis, that puts us at 2.2% for the headline, a big drop from 2.6%, and the core is at 2.4%. Now, the professional economist category likes to get rid of the trade services, which is based on margins for retailers and wholesalers. And if you do that, that actually went up because it went up 0.3 instead of 0.1 last month, and more than anticipated. So that pushes the core to 3.3% from 3.1%. But we'll have to take a look at what it was that pushed that up, because last time it was basically the retailer margins that pushed it up, and that wasn't considered a significant inflation issue compared with some of the other things in here.
Well, why don't you take a minute to really look through some of the numbers so you can break out some of the specifics. In the meantime, what you can see in markets is a pretty significant response. S&P futures up now 0.6%, almost 0.7%. NASDAQ up almost a full percent on the heels of this report. Even the Russell 2000, and this actually highlights just how interest rate sensitive it is, up about 0.8%. In the bond market, yields markedly lower across the curve. You can really see a bit more of a bid into the bond market led by the 2-year, because essentially this seems to be giving a green light to the Federal Reserve to come out and really cut rates potentially even more aggressively this year. When you bleed that through the currency market, you could see dollar weakness. It reverses some of the earlier sense of dollar strength, 109.36 on the euro. Mike, you've had a couple minutes. What are you looking for?
Well, the interesting thing here is there's a complete flip-flop, 180 degrees from previous PPIs, in that it was prices for final demand goods that went up 0.6 during the month, while final demand services fell 0.2%. Usually it's been the other way around. And the reason that we saw a big rise in final demand goods was gasoline prices went up. That's the major issue there, a 2.8% rise in gasoline prices. And final demand trade services, which we talked about, fell 1.3%. So that's a contraction in margins, and that is has some implications, I guess, for equities as we go forward. But it is a big change from what we saw in the prior month.
Well, this market tends to like to use PPI as a way to position into CPI. Whether that's successful or not is a different story. Is there anything you see from this that would give you any sort of indication for data to come?
Well, I haven't gone deep into it, but obviously we have to take into account the idea that gasoline prices may have gone up. The wholesale and the retail prices don't match up on a regular basis, so that may not be the case. I'll take a look and see whether we get whether we have anything in terms of things like airfares or cars that sometimes match up. You can't really take PPI as a precursor to CPI. Basically, the easy way to say that is middlemen. because people from the producer side sell it to the middlemen who mark up prices and then they send it on. And so we don't know exactly what we're going to get from CPI. But this is only the second time this year that we've had PPI before CPI. So what most people are doing is just looking at PPI as an input into PCE.
Well, one thing that I love about you, Mike, is that you always parse deeper and deeper into the data after it comes out. And there are many, many lines, and he has them all open in the huge PDF document. You will continue to do that. Please stay close so we can come back to you afterwards to figure out what you've gleaned. Joining us now, I'm so pleased to say, is Matt Luzzetti of Deutsche Bank. And I want to start, thank you so much for being here, Matt. I want to start with your impression of how predictive, to Danny's point, this PPI print is for tomorrow's CPI.
Yeah, I would agree with Mike that not very. Usually what we look at are the few components that go into PCE that inform the inflation gauge that the Fed focuses on. So they're portfolio management, healthcare, a few of the other airfares or used car prices are most important. I would downplay what we're seeing in the headline or the core just for that reason. I think there's, we'll have to go through some of the details. There is some reasons to think that some of those components could have been stronger. So portfolio management, inflation, one, tends to lag the market. So the strength we had in markets in prior months should actually lift that inflation component. But I think ultimately it has little feed through into how we think about the CPI beyond those components that matter for the PCE. I wouldn't change too much of how we're thinking about the CPI tomorrow, but the market is lean in a very dovish direction from a CPI perspective. The market pricing is around a 0.1% core CPI print below what consensus is expecting. So the market is kind of anticipating soft inflation numbers, which allow the Fed to begin to cut rates.
And this really is basically feeding into that kind of coiled spring that we've got coming into tomorrow in terms of that dovish positioning. Is there anything that you're seeing in the data that should push back against that? Because at one point you were more dovish than the market in terms of rate cut calls. Now you're actually more hawkish than the market with 3 rate cuts for the remainder of this year. So is there anything in this data that would give you pause before throwing your hat in the ring and saying, you know what, market, you're right?
Yeah, things change quickly. As you mentioned, about a month ago, we shifted to 3 25 basis point back-to-back-to-back cuts, and it was viewed as aggressive at that point in time. I think from the Fed, what we've heard from them is wanting to kind of take a step back, be able to see the data. I think my read on the data is you have a clear slowing, including in the labor market, but it's not recessionary at this point in time. You still do have inflation that's above target, but I think inflation risks have really dissipated. And so I think the Fed should be very comfortable cutting rates. Should they go by 50 basis points? The market has been priced kind of 50-50 for that at this point in time. I think the data will determine it. So if we get confirmation in the next jobs report that the latest weakness was real, then I think it could be quite likely that the Fed cuts by 50 basis points. If you see a reversal of some of that weakness, which is my baseline expectation, if you have the consumer continue to come in resilient, then I think that the Fed can have a path here of going by 25 basis points at each meeting.
Can you just break down what the difference of going 25 and 50 is on impact? Is it signaling, or is there actual economic legs up that they give the economy by going by 50 instead of 25?
Yeah, so at the moment, a lot of this is already priced into the market, right? So 2-year yields are reflecting an aggressive rate cutting cycle, a little bit more aggressive than we're anticipating. I think markets are reflecting that at this point in time. So if the Fed were to go by 25 basis point increments rather than that, yields would rise. Maybe you see equities come down a little bit. But I'm skeptical that the Fed, being a little bit more hawkish, is going to tighten financial conditions aggressively. And the reason is the only way that they would do that is if the economy is looking resilient. And I think the market is highly leveraged to negative news on the economy, as we saw with the jobs report, anything that looks like it's a downside risk. So I think if we get resilient news on the labor market and consumer, financial conditions can remain easy, even if the Fed only goes by 25 basis point clips.
Are you surprised or even maybe concerned the Fed hasn't given themselves that optionality, announced that optionality of doing 50 basis points, that at the moment they're still discussing whether or not to do even just 25?
Yeah, I think, what we will often hear, they make decisions at a meeting and it's only for that meeting. I think what we've heard from Fed officials since the jobs report and since market volatility has been entirely appropriate, which has been, yes, there was some weakness in the labor market data, but they are not overly worried about it. They're not worried that it was signaling recession. I think what they were seeing in markets they thought was being driven by technicals and positioning and an unwind of positioning. And so far, I think that's played out. And the market went from pricing over 125 basis points this year down to less than 100. And if you get good data, I think it'll give them the optionality. So I think they're in a fine place at this point in time. And Chair Powell at Jackson Hole can help guide us on how they're thinking.
Matt, you say the consumer's resilient. What do you make of what Home Depot said this morning, which is that they're in this deferral mindset, that they're waiting to make big purchases?
Yeah, I think resilience is definitely different than kind of robustness or strength. And so I think we're coming from a consumer environment where you just had a very robust consumer over the course of 2023, and it was across the income distribution. It was kind of hard to find pockets of weakness. You now do have some pockets of weakness. You do have some pockets of softness. I think it's more reflecting of a normal type of an environment. That said, the labor market data does have some risks to it. Job gains did slow. We think some of it was due to hurricane effects, but they have. The unemployment rate has risen up to 4.3%. And job gains remain resilient only because layoffs remain low. So if there are risks that I am looking at, it is that layoff picture changes. And that would clearly undermine the consumer in a way that turns it into kind of a more negative dynamic.
If we are now at 4.3%, the unemployment rate is basically what the Fed wants to be at the end of the year. Does that in itself signal that they are behind the curve?
I don't think it signals that they're behind the curve. I think it signals that their dot plot in June is not appropriate at this point in time. So when they set that forecast with that unemployment rate, they had one rate cut this year. I think that no longer is a reasonable view at this point. I think it's more likely that the debate is between going 25 or 50 basis points. And I think that will be a real debate. And I think it'll be dictated by the data. I honestly think that there's compelling arguments on both sides. They are restrictive. The inflation data is telling them that there's not as much upside inflation risks. And then it depends on whether or not the economy is actually as resilient as we think. If it is, then I think that they should go by 25 basis points. And I think they probably will. But if we get kind of confirming evidence on the labor market front, that gives them scope to go more aggressively.
Giving some credence to that 50 basis point rate cut thesis. If you are just joining us, we did just get that PPI number, and it did come in softer than expected. Inflation, then not necessarily the concern, and opening the door really to the Fed to cut rates perhaps even more aggressively. 0.1% was PPI final demand versus the expectation of 0.2%. That leaves the year-over-year final demand at 2.2%. versus the expected 2.3%, pretty much across the board. It seems softer. What you see in markets is pretty much a collective cheer. You see across the board, stocks rally much more aggressively, led by the NASDAQ 100. You also have bonds rallying as you see two-year yields fall below 4%, solidly so, although we're tracing some of the earlier rally that we saw, 396.68. It's pretty much across the board. The biggest bit, though, into the two-year. And if you bleed that through foreign exchange, you see the dollar softer as you expect some sort of rate cutting cycle to commence, certainly in September. Question now the depth of it. The euro gaining versus the dollar, 109.45. Michael McKee still with us here, our economics correspondent. What are you seeing in the details of this report?
Well, the big change, as I mentioned earlier, was that services prices went down while goods prices went up, largely because of gasoline. But we also saw passenger car prices fall 0.2. Healthcare prices were basically flat. Insurance prices basically flat. The big increase in the numbers came from portfolio management. Matt Luzzetti's colleagues are causing inflation at this point. Portfolio management prices rose 2.3%. One of the biggest moves in the whole PPI. So the fact that you get paid either way works out.
Well, Matt Luzzetti is still with us and can respond. I mean, what do you make of the details?
Yeah, so portfolio management rose as I kind of signaled, I think. Actually, I think maybe the most important thing was healthcare being flat. So healthcare in the PCE is 20% of the core PCE index. It's basically as important as rent and OER. We've been signaling some upside risks to that because it tends to be leveraged on healthcare wage growth, and that's been very strong. You got a soft print there. So that is, as a read-through to core PCE, it's a very good indicator for the Fed.
Matt, just while you've been talking, I've been looking at the interest rate probability tick lower and lower. I mean, not a dramatic move, but you were saying it's about 50-50. It's now more than 50% chance that they go 50 basis points the next meeting. Are we putting too much weight on each individual data point as this market rolls on?
Yeah, the market is highly sensitive to each data point. I think you're seeing some big moves. It doesn't take much to move, by 10% for a cut. It's only 2 bips in terms of the pricing. But, it makes sense. We're in an uncertain environment at this point in time, and the Fed is providing little forward guidance, I think, appropriately. If the Fed is providing little forward guidance, then it means the Fed is data dependent, and we should be sensitive to those moves. I do think the healthcare component here is important. That being flat rather than strong is a dovish signal for the core PCE. We'll have to wait what we get from the CPI tomorrow.
Matt Luzzetti, really, really smart. Thank you so much, as always. Matt Luzzetti of Deutsche Bank here with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Shares of Starbucks are surging in the pre-market after the company announced it's replacing its CEO effective immediately. The coffee giant naming current Chipotle CEO Brian Niccol as its next leader. This coming as the company is working to turn around its business as consumers pull back. Plus, as it faces growing pressure from activist investors. The Seattle-based company said Niccol will start as CEO and executive chairman of its board on September 9th. The Wall Street Journal is reporting that China's Huawei Technologies is close to introducing a new AI chip. The chip would allow China to overcome U.S. sanctions and challenge NVIDIA in the Chinese market. According to the report, Chinese internet companies and telecommunications operators have already been testing Huawei's latest processor. The company told potential clients, according to the Wall Street Journal, that the new chip is comparable to NVIDIA's H100, which was introduced last year and isn't directly available in China. And the NFL is meeting with a handful of private equity groups this week. According to people familiar with the process, it's a step toward opening the league's ownership ranks to institutional money. The meetings are intended for the league to conduct more due diligence, but also to talk through potential policy preferences. The NFL is the only major U.S. league that doesn't allow institutional investors. It has spent more than a year observing results from other leagues and discussing what it might do differently. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, heading up for the day ahead, also a discussion with David Rubenstein, the co-founder of Carlyle. This is Bloomberg. We are about 17 minutes away from or after what we got from PPI, and it did come in lighter than expected. Markets are responding pretty much as you would expected. They are flying, although we're tracing some of the earlier gains. S&P futures up about 0.5%. You could see dollar weakness now as people price in a greater than 50% chance, as Danny was talking about, of a 50 basis point rate cut by the Federal Reserve, and yields are markedly lower across the curve as people gauge just how much room the Fed has to cut rates. Right now, I want to turn to somebody who typically joins us to talk about his various properties. He has many of them in all different aspects of the world, but particularly with his Bloomberg shows. David Rubenstein, who is host of Peer-to-Peer Conversations and the co-founder of the Carlyle Group, and who also hosts Bloomberg Wealth, and who also owns a massive baseball franchise. Before we get into all of that, I do want to talk about your upcoming conversation with David Solomon of Goldman Sachs, who you spoke to amid some of the market turmoil that we saw last week. What was his take on it, and potentially how much was stemming from uncertainty around the Fed and around what we're seeing in the U.S. economy?
Well, he obviously recognizes there's going to be some turmoil in the market for a while. He said that in the interview, which will air tomorrow night. David's been the CEO for about 5 years. I've known him for a long time. I tried to recruit him to come to Carlyle about 3 or 4 different times. I failed every time. Very talented person. He obviously had some turmoil early on in some of the parts of what he was doing, but he's now seemed to be in really strong shape. The Goldman stock is doing quite well. The performance is very, I'd say, strong. And he is worried about the debt around the world, the amount of debt the U.S. government has, the amount of debt consumers have, the amount of debt that a lot of countries have. So that's one of his concerns. But generally, he doesn't see a recession or a depression coming anytime soon.
You didn't get him, but you did get Harvey Schwartz, so you didn't do too badly in terms of recruitment. I am concerned, though, about just the divergence that we're seeing with respect to what CEOs are saying, and then some of the data that's coming out that just seems kind of messy. From your perspective, from your vantage point as an interviewer of David Solomon and all of these other behemoths in the finance industry, but also overseeing and really understanding consumer dynamics, where are we in this pendulum of weakening but not yet weak?
I don't think most people think we're heading into a recession. Now, obviously, we have recessions typically every 7 years in the U.S. economy. We haven't had one for a while, a real recession. So it wouldn't be a shock if there was a recession, but I don't see that happening anytime soon. The economic data is still pretty good. Most people expect the interest rates to be lowered, probably, I suspect, in September. And I think when that happens, I think the market will respond favorably.
Do you think that it would be prudent for the Fed to cut by 50 basis points?
I would think it's prudent for them to cut back interest rates, whether it's 25 or 50, I will leave to the Fed. But I think it's unlikely that the Fed will say, because of the election season, we won't do it. In other words, I used to think that the Fed would not do any cutting before the election. But I now think the signs are so strong that they should do so, that I think that they will do a cut of 25 or 50 basis points in September. And that's what David Solomon thought as well.
And in the meantime, as the market tries to figure that out, it's been whipsawed back and forth. And probably a good example of who to talk to in one of those moments is the legendary energy trader John Arnold, who you speak with for an upcoming episode of Bloomberg Wealth. And you talked about this idea of his trading strategy. I just wonder if any of that is kind of applicable to today as people try to trade these markets and really grasp for what the direction may be.
Well, John Arnold, for those who don't know, was a legendary trader at Enron, then later started his own company, and he had rates of return that were over 100% a year. And he did what most people don't do. He retired. He just retired to give away his money and work with his wife on a philanthropy. A very impressive person. He's now on the Meta board, and he's helping Meta decide what to do with the energy needs for artificial intelligence, because his expertise is energy trading. A very impressive person. I would say that the volatility in the energy markets will probably abate a bit sometime soon. But he's not in energy trading right now for third parties. He may trade for his own account. We don't know what he's really doing. But he's mostly spending time on philanthropy. I would say he's a very impressive young man. He became a multi-billionaire well before the age of 40.
What's the advice on the energy infrastructure to power these massive data centers because of AI?
There's no doubt that AI requires a lot of energy, and there's a lot of concern about whether that's going to be good for the environment or not. And most of the big tech companies are now focused on that, and I think rightly so. But I think that's a problem that will be solved in time. And clearly, alternative energy will help mitigate the problem, I suspect. Right now, I think one of the biggest things that people are focused on is who's going to be the next president of the United States. So, as you know, most people thought that there was a pretty good chance that Donald Trump would win, because running against Joe Biden looked like he was going to win. Many people thought that. Now it's a jump ball. Nobody really knows who's going to win. And I think we're going to see a lot of turmoil in the markets till the markets really say, yes, X or Y is going to be president of the United States.
You just sat down with David Solomon. You just sat down with John Arnold. What are they thinking about U.S. politics right now?
Well, they try to avoid it, just like I try to avoid it, too. But they may be more involved in politics than I am. I don't get involved in giving money to any of the politicians. But
you don't give money, but you talk to everyone.
I talk to them all. In fact, I have a book coming out in a couple of weeks on the presidency. I interviewed Donald Trump for the book, and I interviewed Joe Biden for the book. And it's about the presidency and the importance of it. And it's called The Highest Calling. Now, I used to say that private equity was the highest calling of mankind, but I had to admit that the presidency is probably a higher calling than private equity. But it's very close.
I love that you say that you try to stay away from it, but you were the one who brought it up, and so we have to go there. There is a real question here about how much turmoil there actually will be, and some people are saying, I'm not going to get into it, and it's not going to be that significant. Where do you see the balance of risks? I mean, what is the Harris trade?
Well, I think right now the markets are uncertain as to who's likely to be president. It's clear to me that she's gotten much more support than people thought she would have gotten, because, remember, as vice president, she wasn't as visible figure as some other vice presidents have been. And the Biden people thought that only Biden could get elected. Now they recognize that she can probably get elected. I think President Trump has not yet figured out exactly how to attack her, and I think the campaign is a little uncertain, but he's a smart man. He's gotten elected before, and I think it's going to be a pretty close election either way.
Do you sleep, David?
I'm sorry?
Do you sleep?
About 5 hours a night, but that's enough.
David Rubenstein, always impressive of the Carlyle Group in terms of just the quality and scope of everything that you do. Thank you so much for being here. You can watch David's conversation with Goldman Sachs CEO David Solomon on Peer-to-Peer tomorrow at 9 p.m. And, of course, coming up as well on another of his properties, Bloomberg Wealth tonight, David's interview with John Arnold, Arnold Ventures co-founder and co-chair. Counting down to the opening bell, here is the trading diary for the week ahead. Today at 1:15 p.m. Eastern, we hear from Atlanta Fed President Raphael Bostic. Will he weigh in on PPI? Tomorrow, U.S. CPI. On Thursday, we'll get retail sales plus another round of jobless claims, as well as this, Walmart reporting earnings. After the bell Friday, we'll round out the week with UMich sentiment plus more Fed speak from Chicago Fed President Austin Goolsbee. Coming up tomorrow, Stuart Kaiser of Citi, Marriott CEO Tony Capuano, former Chicago Fed President Charles Evans, and Gargi Chowdhury of BlackRock as we parse through what we got today with PPI and look ahead to CPI. This was Bloomberg Surveillance.